if you're over age 50, there is a catch-up provision which will allow you to go ahead and put an additional $1,000 in your IRA above the maximum contribution limit. All right, so I guess we're going to talk about this now. All right, so you can put up to 100% of earned income, and it tops out at an index maximum dollar amount. What was it last year? Last year it was $6,000. What is it this year? All right, well, actually, I don't know. It's 2022, it was 6,000. 2023, it was 2024. It was $6,500. I'm sure they went ahead and they bumped that up. During one of the breaks, I'll have to look that up and find out what it is for you. All right, and the spousal IRA can be for the same amount. It's offered by financial institution, banks, insurance companies, investment firms, and have a wide variety of investment options. Here's the rub on a traditional IRA, folks. Since you went ahead and put the money on there and you got a deduction for it when you did it, then what you withdraw is going to be either fully or partially taxed. All right? Because you got a deduction. The government wants their money back. All right? And there is a required minimum distribution required. All right? In 2022, it was basically age 70. All right? And no, 70 and a half, that's what it was. In 2023, it was age 72. They bumped that up. What about 2024? I don't have that. I have to look it up in the break. So let me write it down so I don't forget, because I know inquiring minds want to know. All right, so that would be maximum dollar amount. Okay. And also required minimum distribution. Okay, age. So during our next break, I will find that out for you. Well, when is our next break going to be coming across? Well, it's actually going to be coming across in 48 minutes. 48 minutes, we will take our next break, folks. All right, so let's go ahead and let me take a look at the chat here. Oh, thanks, Alan. Alan says 7,000, but over 50, you can go ahead and do 8,000. All right, and I'm just, I hope I don't insult you, Alan, but all right, then basically, I'm just going to have to look it up to verify so I can know, and so I can tell the powers that be to go ahead to change the amounts if there's any changes that need to be made. Okay, so thanks for your response, folks. Let's go ahead and we will mush on. All right, and the next one we're going to talk about Roth IRAs. Guess what, folks? I've got, oh, thanks, Caroline. All right, but I still will have to check because it's my job. I got a responsibility. All right, Roth IRAs. Guess what? I've got a Roth IRA. And why did I choose a Roth IRA over a traditional IRA? All right, well, there's a lot of similarities between the two until we get down to the bottom. All right, again, just like the traditional, it's available to all individuals who have earned income. It's funded by cash. It's you can't deduct it, all right, from your taxes, where you could with the traditional. You still have tax deferral of gains. You still have the catch up. And, all right, the maximum contribution limit, all right, where it tops out. All right, so last year, I was waiting. Last year, I was going to put in another deposit for my IRA, but I couldn't do it until January 1st of last year. So when January 1st came along, I went ahead and I went ahead and made a deposit of $7,500 into my IRA, which is the $6,500 minimum or the maximum limit, and the $1,000 catch-up provision because I am definitely over 50. So that's what I did, and this is a good reminder to me because now I've got to go ahead and put another donation into my IRA. Well, why do I do that? All right. Well, you know, here's the reason why. Distributions are qualified. They're not taxed. It's tax-free income. And there is no minimum distribution required. All right. So I can leave those in there to grow, tax deferred. And when I run out of money from the other areas that I have to support me in my retirement, at that time I'll start taking distributions from my IRA because I want to grow, like a flower that you find, zoom, it just goes ahead and pops right up. I want to make sure that that has got as much money because when I take it out, there will not be any tax liability. All right. Well, guess who goes ahead and sells IRAs? Insurance companies do. All right. You can go ahead and get an IRA, and one of the things that I kind of like is doing an annuity in an IRA wrapper. Because if you do that, your payments are not going to be taxable. All right. So yes, general lines, accident and health license. Well, if your general lines are 220, you can do health. All right. I don't think that health will go ahead and you'll be able to sell health insurance, accident, disability. You'll be able to sell all sorts of stuff, but as far as it goes for an IRA, I don't think so. I think that you will need to have, all right, some kind of license to go ahead and do that. And all right, you can make contributions, all right, but if you're going to sell them, all right, I think in that case you might rather be thinking of going ahead and getting your Series 6 or Series 7, because you can go ahead and you can put a mutual fund requirement account in an IRA wrapper. Okay, but that's an excellent question, Jack. All right, can you sell IRAs? Not necessarily with the general lines. All right, but life, accident, and health license, yeah. I think you could go ahead and do that. But, rest assured, one thing, that's not going to be on the test. All right, so take a deep breath. All right, so that's the difference between a Roth and a traditional. My preference is I'll take the Roth, thank you very much. I'll forego the tax deduction now. And, hey, what's the tax rate going to be in 5 years? Nobody knows. All right, and so, I'd rather go ahead and pay it now, and if it goes up higher in the years to come, well, I don't have any worries because I don't have to pay any taxes. That's why I like the Roth IRA. All right, old age survivors disability health insurance, all right, which is basically Social Security. All right, it comes from funding. The employer pays half, the employee pays half, and if you're self-employed, you have to pay the whole amount. All right, are those rates right? I have seen other rates, and maybe that's another thing I'll have to go ahead and look up. All right, but with FICA, all right, the employer pays half, the employee pays half. If you're self-employed, you got to pay the whole nut. All right. What does Social Security offer? Retirement programs, disability programs, survivors programs, and a death benefit. Currently, $255. Whoopee. All right. I'm sure that was a lot of money 10 years ago, but now, hey, you could probably get a tank of gas for $255. You know what I'm talking about. All right. So let's continue to go on. All right. Qualifications to be fully insured. You have had to work 40 quarters or 10 years contributing to Social Security. That's to be fully insured. All right. But you're currently insured if you have 6 quarters of coverage during the past 13 quarters, which resulted in the loss, which is, let's say, a disability. All right. How can you have, let's say, somebody 24 years old is disabled, files for Social Security disability. They've had to have 10 years in to fully qualify. Well, that would mean they'd have to start working when they were 14. It's against the law to work when you're 14. Okay? So they make adjustments, and they also make adjustments on the money. You're currently insured if you've completed 6 quarters of coverage during the past 13 quarters, which resulted in the loss. Here's another thing you're going to see a few more times, I know. That's your primary insurance amount. What is that? Well, that's the amount that you're going to go ahead and get at full retirement benefit at your full retirement age. Every one of you has got a full retirement age. And I bet you more than half of you don't even know what that is. All right, so here, let's take just a little break from the routine. Go to SSA.gov, folks. SSA.gov, and you can enroll. Even if you're not 65, if you're 20, you can still enroll in SSA.gov. What it will do is it will give you the projected amount of money that you would have as a monthly payment when you retire. If that's not enough, then folks, you got to make other plans. All right. And if you wait too long, you're going to run out of the time value of money. All right. Quick little story. Gosh, I get in trouble when I do this, time-wise. I loved it when somebody 20 years old came over and sat at my desk. All right, because after I take care of what his insurance needs were, I'd ask him this question: how would you like to retire as a millionaire? How many no's do you think I got on that when I asked that question? And so I took a few minutes to go ahead to show them how they can do that. When I was doing that, the average rate of return for a mutual fund was about 15%. And so I'm going to hold this thing up to the screen, all right, so you can see it. It's a financial calculator. And Texas Instruments makes it. It gives you the time value of money. Very important. I made so much money with this little $20 calculator than you can imagine. All right? But I'd work out the time value of money. If you don't have the money to buy one, you can get one either at calculators.net or calculators.com. Time value of money, that's what you want. So I went ahead and I said, all right, so we want to have $1 million when you retire. Let's say you retire at 65. That gives you 45 years to save. And so 45 times 12, that's 540 monthly payments that you're going to go ahead and put in. And so I put all this stuff into my computer here, and then we figured out how much money this 20-year-old has got to pay to have $1 million to retire on. You know what the amount was? And I kid you not, this is the real thing. Run the numbers you want if you want. At 15%, At 540 months, he'd have to save $15.58 a month. Holy crap, to have $1 million when I retire? Wow, that's a great deal. Yeah, it's a great deal because basically you've got the time value of money. Hey, guess what happens 20 years later? The amount that you have to save is going to be a lot higher. And we're going to look at that, all right, in the screens to come. All right, so you've got your primary insurance amount is averages your monthly earnings that you want to put into the system that determines what you get out of the system. All right, and so let's do this activity. All right, I guess that screen's going to appear a little bit later on, but I'm not going to forget it. All right, a self-employment retired vehicle. What would that be? I would say it's a SEP or a Keogh IRA. Hey, look at that, I'm right. Don't tell my wife. All right, next, entitled to retirement benefits. When you're entitled to retirement benefits, you're vested. All right, and who regulates retirement plans? ERISA. All right, what about non-deductible options for your contributions? That's basically non-qualified plans and Roth IRAs. And last but not least, to qualify for full Social Security benefits, you have to have 40 quarters. All right, and as time goes on, one of those, the last quarter drops off, and then you, if you're making more money, you're going to have more of a benefit. You're making less money, you're going to have having a less of a benefit. All right, but anyway, be that as it may, let's go. We've ended section 7, and now we're going to take a look at risk and insurance. All right, and I won't forget those things because I wrote them down. And when I write them down, I don't forget them. Okay, so risk and insurance. The carrier equals the company equals the insurance company equals the insurer is not the same as the insured. Those are the people that buy insurance from the insurer. All right, so what is insurance? It's the transfer of risk. It's defined as the uncertainty or chance of loss. Pure risk is the chance of loss only. And in life insurance, that's loss of life. And only pure risk is insurable because the other kind of risk is speculative risk. All right? And so they say you have a chance of a loss or gain. And they give the example of a lottery ticket. Well, I don't know if that's the greatest example of a speculative risk because the lion's share of that money that you put into that lottery ticket is going to be lost. All right? I know, I've heard people say that the lottery is nothing more than a tax on people that can't do math because the odds are so high. All right? But, interesting fact, you can't win unless you play. So I know there's people that go up to the window and buy 50 or 100 lottery tickets. No, man, I just get one. All right. So the chance of a loss or gain. Yes, you can have a chance of a loss, but you can have a chance of a gain. Only losses are insurable. And I pity the poor insurance company that decides to insure lottery tickets. All right, the only way I can see them doing that is they charge you $5 a ticket, and if you lose, they refund you $1 or $2. It's not worth it, right? Okay. All right, so next, the peril. The peril is what caused the loss. And in life insurance, it's the death of the insured. Insurance spreads the risk and reduces the financial uncertainty associated with the loss. That's what insurance is. It's a large group of people that pay premiums that share a common risk, all right, and those premiums go to pay a smaller group of people that actually collect on the insurance. And so as long as you have more people than more people putting in money than you're paying out risk, you're doing rather well. But you get into trouble when that risk, the payout grows, and you don't have enough money collected to pay the losses. All right, that's when an insurance company gets to be insolvent, and your state has a eagle eye agency to go ahead and watch over that to make sure nothing happens. And if something does happen and an insurer goes bankrupt, then your state has instituted, hopefully your state has instituted a guaranteed risk policy, where if they will go ahead and they will pay the claims of insolvent insurers, because that's one of the things that insurers have got to do. They've got to contribute a percentage of every premium they collect on every policy to this fund, so that if one company goes under, they've got the money to pay the claims. All right. So, saying that I don't know if that probably might be on your test. All right, but I don't think I see it here. So it's a contract of indemnity. What is a contract of indemnity? There's a stated benefit of certainty which reduces a uncertainty. All right, we just had an event here where Tyreek Hill, a receiver for the Miami Dolphins, guess what? He had a fire in his house. I'm sure he had insurance, but you know how the fire started? His kid was playing with a lighter. Now, if that was self-intended, all right, I don't know if he's got coverages to cover the damage for that fire on his mansion down here in Southwest Ranches. All right, so it's a contract of an indemnity. If we have somebody that says, hey, if you die, I'm going to pay your beneficiary $100,000. Great, that's a contract of indemnity. All right, it's designed to make the insured whole again, not to make them profit from the catastrophe. And that's what we find down here in South Florida. People, when they do have a loss, they want to multiply that loss 3 or 4 times so they can go ahead and put more money aside for them. All right, now I'm not going to go ahead and get into it because it's a problem. Down here, though, just so you know, life insurance agents, all right, they're sought after, okay, because there's a lot less hanky-panky in the life insurance business. None, but there's less. Let's just put it like that, than property and casualty. All right, we're going to talk about sharing risk. What does a company do to manage risk? All right, so if they manage the risk, then they're going to have more money to pay claims and they're going to make a profit. Well, what do they do? First thing is they share the risk. Well, what is meant by sharing the risk? All right, classic example. You're in your car. You have an accident. It's your fault. You've got to pay a deductible on your insurance to go ahead and get your car fixed. Basically, what you're doing, you're sharing the risk. And the more risk that you take, let's say instead of a $500 deductible, you bump it up to $1,000. Well, that's less risk for the insurance company, so there's going to be less premium demanded for you because you are assuming more of the risk. And so you can do that by risk sharing, by having deductibles associated. I haven't seen a lot of life insurance policies with deductibles, folks, but I wouldn't put it past them. All right, now that's not going to be probably on the test. All right, another thing they can do, they can transfer the risk. Well, how can you transfer the risk? Well, basically, you would sell a portion to the risk to a reinsurance company. And there are tons of reinsurance companies. Down in Florida, it's hard to find one. because because of the litigational aspect of things down here. They don't want to lose any money. Therefore, they're not actively seeking insurance policies to take over. And it makes it really rough in the property and casualty arena down here. All right, well, I'm not going to, let's just go ahead and say you can share some of the risk by transfer it to another company. Another company offers to buy 25% of the risk. Fine, you sell your insurance policy to another insurance company, and you pay them a premium to manage some of your risk. And if something happens, then you pay your percentage of the risk, and the reinsurance company pays their percentage of the risk. Next, risk avoidance. How can you avoid the risk? Well, they do that by exclusions. You're avoiding the risk. We're not going to pay. If you're a private pilot and you've only had your certificate for 15 months and on and on, no, we're going to go ahead and put an exclusion on that policy that will not cover you if you die in a private airplane crash. That's how you avoid the risk. You exclude whatever it is on the policy. For soldiers, for war, remember we talked about the two different avenues of war exclusions? One, if you die in battle, nope, there's nothing. But if you die on the base and you're not involved in a battle or a skirmish, then it's payable. All right? So next, reducing the risk. All right, well, how do you reduce the risk? Well, basically, I've seen this happen in property and casualty policies. They basically put a limit on the coverage that you receive. For example, water damage is the next highest loss right next to hurricane. All right, so what the companies will do, because they got to pay out all this money, so they've got to reduce their risk, and so they will limit any water damage done in your home to only $10,000. Well, what if I have $40,000 in water damage? Here's your $10,000 check. We're reducing our risk by limiting the amount of coverage that you get for that particular peril. Okay. All right, so next is risk retention. All right, well, what about retaining the risk? All right, but you can use underwriting rules to go ahead. You retain the risk, but you can limit what's insurable by your underwriting. All right, retention. That's another thing about the limitations on the perils. All right. Well, you're retaining $10,000 of the risk for flood, but anything over that, sorry, Charlie, the policy only covers $10,000. Or you can retain the risk, which basically means, remember, we talked about adverse selection. It's going to be on the test, folks. You're going to see it. You're going to say, Jerry told me so. All right. Adverse risk is having more bad risks than good risks. All right. And so risk retention, you have more good risks to pay the premium or the claims for the smaller risks. Risk retention. Next, risk protection. All right, well, that's protecting you against risks. All right, well, down here in Florida, they will give you a credit if you have hurricane shutters. All right, that's protecting the wind from entering into your house and causing further damage. So if you spring for hurricane shutters, they will give you a reduction on your premium and give you a better rate. So you can go ahead and protect yourself against those things happening. And if you do, your insurance company will go ahead and help you. All right. So risk protection, there's things you can do to protect your car. Let me ask you guys, if you have a car, all right, do you get a discount if you have an alarm on your car? Well, yeah, you do. All right. And so that's protecting against risk. You've provided the anti-theft protection device that lowers the company's risk, therefore risk protection. All right. So let's continue to move on here. And according to my schedule, we've got another break set up here in, let's say, about 31 minutes. All right, so we are going to go ahead and continue. I don't know if it's going to be a 15-minute break because we are running behind in our screens, and I want to get you out of here at a decent time. All right, the law of large numbers. All right, we talked about this before. It can predict losses better, but it doesn't have anything to do with the losses. All it does is it becomes a more accurate ruler to determine what kind of losses that you will receive. All right, it aids in the calculation of policy premium for either individuals or groups insurance. And we talked about adverse selection. Adverse selection is not in favor of the insurance company. Remember that. Adverse selection is not in favor of the insurance company. All right, if the insurance company has more bad risks than good, they're in trouble. All right, a hazard, as it may affect the financial condition of the insured. Hey, this last hurricane that we had that went through Fort Myers, all right, they're still reeling from that. There's companies that gone out of business because of it. All right, policy provisions can also assist, meaning pre-existing conditions or suicide clauses. And last but not least, the profitable distribution of exposures, having an adequate number of good risks to offset the poor risks. All right, and if you have more bad risk than good risk, that's adverse selection. All right, the sixth activity here. All right, so the law of large numbers will prevent losses. I just said that. No, it doesn't prevent losses. It gives you a better idea on the losses you will have. A contract of indemnity transfers losses. Yay or nay? I say yes. That's what an insurance policy is. It's a contract of indemnity that transfers your loss to the insurance company, and they go ahead and pay for any damage or financial loss due to a covered peril. All right, next. A hazard is a way for an insurer to avoid risk. I don't know what they're smoking, but that's a completely absurd statement. That's not the definition of a hazard, and that's what they're going to be looking for on your state exam. Do you know what this word means? Do you know how it's used? Do you know what it does? That's what they want to try to do, and they'll try to trick you in any way they can. Just read the question slowly and look for key words. All right, a hazard is a way for an insured to avoid risk? No, a hazard is a hazard. All right, that would be standing in front of a fast-moving bus. That's a hazard. All right, and chances are, if you find yourself in that predicament and the bus is moving 30, 40 miles an hour, all right, it may end up to ruin your whole day. All right, so a hazard is not a way for the insured to avoid risk, And adverse selection causes financial distress to the insurer. We just got done talking about this. Yes, it does, because he's got more risk, bad risk, than good risk. All right, that's the end of section 8. We are now in section 9, and we talked about parties to the contract. Two-party contract. The owner is the insured, and the company is the other party. Next, a third-party contract. The owner is not the insured. For example, a business buys a policy and the life of the key person is insured, where the insurance company is the third party. That is a third-party contract. Next, an insurable interest. In order to purchase insurance on a person, the owner must possess an insurable interest in that person. All right, so let's see here. Hold on a second. If I were to go ahead and buy an insurance policy on Matthew, all right, well, guess what? I couldn't do it. Why? The only interest that we have is that Matthew was a student in one of my classes. There is no financial responsibility involved, hence there is no insurable interest. So I could not write a policy on Matthew. Couldn't do it. There's got to be an insurable interest. And it's typically based on a financial relationship. All right? And that financial relationship has to exist at the time of the application. All right? It doesn't have to exist 50 years after the policy is written. Just it has to exist at the time of application or at a time of policy issuance. And here again, divorces. A husband buys a policy on himself to make sure his wife has got enough money if he dies. Well, his wife divorces him. All right? Well, they end up having to go ahead to keep the policy, and if the husband dies, then the wife or the ex-wife will get the money. Why? Because there was a insurable interest at the time of the application or the policy issuance. It's not required to exist at the time the loss occurs, and the insured must be aware of the purchase by signing the application. All right, so if it's a third-party contract, all right, there has to be 3 signatures on there. The owner, the insured person, and the agent, okay, on the application. All right, so there has to be the signature and acknowledgement. An individual has an unrestricted, unlimited insurable interest in herself. And that's why I know a woman wrote this. All right, in themselves. However, the amount of insurance is limited by underwriting. All right, so guess what? I've written myself policies. All right, one for my business, one in case I went ahead and died prematurely, so my wife would be taken care of. All right, and so I have an unlimited insurable interest in myself. So, all right, and my wife, all right, is my wife. All right, there's an insurable interest there. What if I wanted to go ahead and insure Uncle Billy? Well, Uncle Billy is part of the family. All right, that's an insurable interest. Matthew, sorry. All right, there is no insurable interest between us. So a policy cannot be written. All right, seconds are ticking off here. Getting ready for our next break, which I'll probably go ahead and do only a 10-minute break so we can make up some time. All right, insurance basics, types of insurers. We have admitted and authorized carriers. We have non-admitted and unauthorized carriers. What's the difference between the two? Authorized and admitted carriers have a certificate of authority. all right, approved by the insurance commissioner or superintendent to sell insurance in the state, where a non-admitted unauthorized carrier does not. Folks, do not get appointed with a non-admitted and unauthorized insurer. All right, they're in there illegally. All right, and if they have a loss and you sold them the policy from a non-admitted unauthorized carrier, the person's lawyers is coming after you. So make sure the company that you're appointed with is an admitted and authorized carrier. All right, next, what about domicile? All right, and so that basically, it means where is a company's home office located? And so it's considered domestic insurance carrier if the insurer has its home office in the state where it's authorized. Example, Mass Mutual in the state of Massachusetts. That's where they have their home offices. Mass Mutual is a domestic carrier in the state of Massachusetts. But what is Mass Mutual a domestic carrier in the state of Illinois? No. They're considered a foreign carrier, an insurer that's authorized to conduct business in a state that it's not its home state, where its home office is in. Mass Mutual is authorized to sell in Connecticut, therefore it's a foreign company in Connecticut and domestic in Massachusetts. All right, the last one is alien. And no, it's not from Martian insurance or anything like that. An alien insurer is a foreign, I shouldn't even use foreign carrier, is an insurer that does not have any offices in the 50 United States, has its home office in another country, but is authorized to do business in one of the states in the U.S. Here's an example, Sun Life of Canada. There's a myriad of companies. There's AXA. That's a alien carrier. All right, there's a lot of different carriers, but here is the deciding factor. Domestic. The office is in the state where they're doing business, where they're authorized. Foreign. They're authorized to do business in a state, but their home office is not in that state. And last, alien. Their home office is not in the U.S. It's across the pond. Or this example they give us here of Sun Life of Canada. No, it's not in the U.S., but they're authorized to do business here. That is an alien insurer. All right, so we got basic types of insurers. We're going to run through this real quick. Mutual companies, stock companies, and we also have the fraternals, right? All right, mutual company, excuse me. Okay, mutual companies are owned by the policyholders. All right, they issue dividends, which is paid back to the policyholders, which is basically an overpayment of premium. Stock companies are owned by the stockholders. If that company produces a profit, that profit goes to the stockholder. Do they issue dividends? Mutual companies, yes. Stock companies, no. Profits go to the stockholder. All right, profits go to the policyholders, profits go to the stockholders, and they're also called participating companies or par companies for mutuals and non-participating and non-par for stock companies. All right, insurance basic, types of insurers. We've got reinsurance companies. And so we mention them when we talk about managing risk. All right, and so insurance purchased by insurance companies to transfer that risk. It spreads the risk out, avoiding catastrophic losses, promotes industry stability, and there's two types of reinsurance. One is facultative, all right, individual agreements used on a case-by-case basis. Or automatic or treaty, which basically every policy that that company writes, the reinsurance company will take a portion of the risk. Every company. All right, facultative, basically on an individual basis. And you'll see here, ABC Company insures an oil refinery for $400 million. Whoa, that's a lot of insurance. Then that company cedes or sells 30% of the risk to CBS and 25% of the risk to XYZ, both for a premium. What if they have a total loss? Then ABC, who wrote the policy, will go ahead and reimburse 45%, while CBS will reimburse 30%. XYZ will go ahead and they will contribute 25%. That takes care of 100% of the loss. If the loss occurs, all these companies will pay benefits. All right, next. All right, insurance marketing and distribution systems. The agency, hey, that's what I own. All right, the relationship that exists between two parties when one party acts on behalf of another. For example, an agent producer represents a particular insurer, or an agent producer can represent a particular agency. All right. The agency is referred to as the principal, while the agent is the authorized representative. Me, good old Jerry Tyler, was the principal of the Tyler Agency. I owned it, and the agents that I licensed to my agency, they were authorized representatives, and I had the power to appoint them. All right, I appointed them with other carriers too, just so they can go ahead and they can protect their careers. But that's another story. All right, 3 types of authority. Okay, one is actual or expressed. These are things that are specifically noted in the contract that you signed with the company. And unless you're appointed with the company, you're dead in the water. You can't sell squat. You have to be appointed in order to sell the policies of the company. Next, implied authority. Usual and customary business practices that may not specifically be listed in the contract. And apparent, all right, apparent authority. Okay, for applied, an example would be an agent signing an application and collecting premium. That's what we do. All right, that's an implied authority. And next is apparent authority, the authority that the public perceives an agent to have. All right, well, one of the things that's probably not in the contract or applied is answering questions. All right, the insured automatically believes that the agent can go ahead and answer that question. And if you ever get a question asked of you that you cannot answer, be very frank. That you just don't know the answer. You can try to go ahead and look it up just to make sure, but don't just go ahead and give them any answer to save face. That's the stuff that lawsuits are made out of. Okay? So, when a contract is in effect, the insurer is bound to the action in which the agent engages. So, companies just don't want to hire anybody. They want to hire people that they feel are compassionate, will take care of their clients, that will do the right thing. All right, even though it doesn't happen 100% of the time, that's the goal that the insurance companies are after. They're after good people. All right, so this might end up doing pretty good, and we go on our break here after we get done with this activity. All right, must an insurer have an office in a state to sell insurance? What do you think? Do you have to have an office in the state to sell insurance? Nah, but you have to have a certificate of authority from the insurance commissioner or superintendent. All right, next question. Does reinsurance transfer the entire amount of risk to another insurance company? Think about that. Take 1 second. Why would an insurance company sell a policy to a company and then sell that policy to another company? Now, what's in it for them? Nothing. All right. So basically, the reinsurance transfer is for a percentage of the risk. All right. The original insurer partially transfers the risk or obligation to pay a claim by partially sharing the premiums received. All right, next, can an agent engage in any means when recommending the purchase of insurance to a prospective client? All right, here again, you can't read it that fast. Let's slow this down, and I will emphasize the key word in it. Can an agent engage in any means when recommending the purchase of insurance to a prospective client? No, they can't use any means. I can't go up to Matthew and say, Matthew, if you don't buy this policy, I'm going to shoot your dog. All right, that's coercion. You can't use any means. They have to be ethical. All right, so you have to follow ethical practices to sell insurance. Unethical practices may be considered unfair, and it may result in both punishment to the agent and the company they represent, which basically means either suspensions or fines. All right, they want to avoid that. All right, so we're done with that. We're going to be into section 10. But let's go ahead and let's take a 10-minute break here, or an 11-minute break, whatever. All right, and I need to go ahead and take care of a couple of things. So that's going to give me enough time to take care of the things I need to take care of. But you guys enjoy your break. We will see you shortly. All right. We are back. I just had enough time to visit the room and get another glass of water so my vocal cords do not freeze up. So let's go ahead and continue our wild and wacky adventure into our insurance here. All right, and let's do that. 4 elements to a valid contract. There has to be the agreement, which is basically an offer and acceptance. Once you take the application, have the premium send it into the insurance company. Then, if it's good with the insurance company will issue a policy. Then it must be good with the insured, and he has to accept the insurance policy that they sent out. The consideration is the lawful exchange of one value for another. All right, the application plus the information. All right, and the premium to the insurance company. Legal capacity, both parties must be legally competent to enter into the contract. All right, minors, all right, I cannot enter into the contract. Their parents can. The people that are insane cannot enter into contracts, or at the time they're under the influence of drugs or intoxicants, or being coerced into the contract, or if they're enemy aliens or convicts. And it has to be for a legal purpose, not to the contrary of the good of the public. Has to have all 4 of these things, or the contract is null and void. Agreement, consideration, legal capacity, and legal purpose. Next, special features of insurance contracts. All right, we've got, we're going to go through all of these. And so it's an aleatory contract, contract of adhesion, unilateral contract, a personal contract, conditional contract, a valued contract, and indemnity contract. All right, well, let's go ahead and stick our nose into this and find out what's going on. Well, it's an aleatory contract. Gee, I never even heard that word before. What's aleatory? Well, it means unequal. It's a contract that may or may not provide more in benefits than premiums paid. So, here's a couple of examples. All right, a guy goes ahead and buys a life insurance policy, sends in his application, and the premium, the insurance company looks at it, approved, it's applied for. They go ahead and they accept his $50 premium. They send him the contract. He goes ahead and signs the contract, returns it back, pays another $50 a month premium, and guess what? He gets killed. All right, he's only paid $100, but his benefit on the life insurance policy was $150,000. That's definitely unequal. All right, and so on the other end of the stick, when I bought my policy to protect my business, all right, I paid a whole lot of premiums and I didn't get anything out of it except the assurance to know that if something happened, that my family would be taken care of. I didn't get anything. That's aleatory. The insurance company, they were the ones that made out on that. All right, next, it's a contract of adhesion, non-negotiable contract. It's a contract drawn up by one part, the insured, because you've never had any input into any insurance policy ever. It's just not done. It's not the way they do things. It is drawn up by the insurer. The insurance company says, yes, we'll write the policy. You accept the policy. And so it is a contract of adhesion. A unilateral contract, a legal agreement which only one of the 2 parties needs to act to make the contract enforceable. All right, and so, all right, and it's usually the insured, because how does the company know if they have a claim, if there's never a claim filed. All right, so next, a personal contract, personal agreements between the insured and the insurance company. Well, life insurance policies are not personal contracts. A personal contract would be my next door neighbor goes into the hospital. I'd say, Blair, don't worry about cutting your lawn on Saturday. I'll do it for you because I know you're feeling a little puny. All right, and so that's a personal contract. Everything done in the insurance biz is done on a piece of paper. It's all signed, sealed, and delivered. And if there's a problem with that, then the lawyers get involved. All right, it's a conditional contract. There's terms specifying the obligations of the insured to keep a policy in force. Really? There's obligations of the insured? Absolutely, and those are listed in the contract itself. I know that in property and casualty down here in Florida, a couple of the things is to make a prompt claim. All right, you can't dilly-dally with the claims. All right, make a prompt claim. Another thing would be to go ahead and prevent any further damage from happening. All right, so if a tree branch falls onto your roof and water's getting into your house and you file a claim for that, you need to do something to prevent any further damage because the insurance company is not going to pay for that. They'll pay for the damage that was done for the tree branch falling through the roof, but any further damage that was done as a result of that, nope, sorry, Charlie, then you're in for a fight. All right, so so there are conditions. All right, next, it's a valued contract. All right, if you pay a stated sum for a premium, all right, then basically, regardless of the actual loss incurred, you'll be reimbursed for that up to the policy limits, if I can go ahead and throw that in there. Life insurance and accidental death and dismemberment policies are valued contracts. Indemnity contract, yes, it will pay an amount equal to the loss. That's why you buy the insurance, to go ahead and take care of the losses. Two keywords here, utmost good faith and fiduciary, are things that are getting rarer and rarer in the state of Florida. Utmost good faith, both parties act with honesty and integrity. And on both sides, the insured and the insurance company has violated those. All right, next, a fiduciary. What's a fiduciary? You, my friends, are fiduciaries. You've been put in a financial responsibility and a position of trust to do what's right for the client. All right, so the client gives you money. You're handling that money as a fiduciary because it's not your money. You don't put it in your checking account. You'll go ahead and get a money order or send it directly into the company. All right, so that's a fiduciary responsibility. Next, statements on insurance applications. And remember a while ago we talked about material misstatements? Well, all right, we're going to get into what different statements are called here. Used to you. First of all, there are representations. Representations are statements made by the applicant at the time of the application prior to the issuance of the policy that are believed to be true or to the best of their knowledge and belief. Those representations can be changed or amended prior to the policy issue, but not afterwards. The materiality of the statement is dependent upon whether it holds influence in determining the policy issue. All right, so that's another way to say the answers on the application would fall within, all right, the underwriting department's good graces. All right, and some representations can become material misrepresentations if they're falsehoods. All right, but we'll go ahead and get to that in just a second. A warranty. What is a warranty? This will probably go ahead and pop up there too. A warranty is a statement made by the insurer or the company's representative that is guaranteed to be true. And that's true past, present, or future. A warranty is generally used when underwriting property and casualty insurance when there are no health questions to be asked of the applicant. And one of the things I'll brace you for now is when you fill out the application for the applicant for life insurance, you're going to be writing a small book, folks. A lot of questions are going to be asked, and the insured needs to answer those to the best of their ability, and those are considered representations. So statements on the application are considered as representations, not warranties. What's a misrepresentation? Well, it's a false statement, but it won't affect the underwriting. All right, for example, if somebody says, I live at 123 North Main Street when they live at 123 South Main Street, that's totally immaterial of issuing the policy. However, it's not true. It is a misrepresentation, but it's not going to stop the policy from getting issued. Whether the false statement or concealment affects the decision to enter into an agreement will determine the materiality of that. And false statements like age, sex, address, telephone number, contact, that will not be a material misrepresentation. So what would a material representation be? Well, it's a false statement or concealment that is important to the issuance of a policy, and it affects policy issue. Generally, health statements, driving record, alcohol abuse, hazardous activities, severity as determined by the materiality is considered false when the facts fail to correspond with the assertions or the stipulations or the answers in the application. Upon discovery, it could be grounds for voiding the contract, in the first 2 years, right? I actually had a guy, when I was working in that auto, man, that was a big mistake working in that auto dealership selling insurance. I had a guy come up to me and he just bought a car, he needed insurance for it. And I said, have you had any accidents or violations in the last 3 years? He said, no, none at all. And so I had to run his motor vehicle record. Folks, I had 5 pages of violations and accidents. Needless to say, he never got his insurance. Why? Because he was lying through his teeth is what he was doing. Okay? All right, so that's a material misrepresentation. If there was a false answer and it would have made a difference in them, the company issuing the policy or not issuing the policy, that is the materiality, and that's why it's called a material misrepresentation. Let's go on to our next one here. Concealment, the failure to voluntarily disclose material facts relevant to the underwriting process. Failure to communicate that which a party knows and ought to communicate. Whether intentional or not, it may be the grounds for rescission by either party. Right? Fraud represents intentional deception. In many cases, the objective is associated with filing a false claim. If determined to be fraudulent, either party may rescind or cancel the contract. Next, activity number 8, a false statement or concealment that is important to the issuance of a policy and affects the policy issue. Let's say I would probably say that would be a material misrepresentation. All right, next, a statement made by the insurer or its representative that's guaranteed to be true. That, my friends, is a warranty. All right, next, the insurer's promise to pay is conditional on certain event or events. All right, and they gave away the answer to this in the question. The answer is conditional. All right, that's a bad question. I wouldn't have put that question in. But anyway, what would be a valid unequal exchange of value? It begins with an A. We talked about it the first thing in this section. It's called aleatory, an unequal exchange of value. If you're wondering about that, write it down. Go back and do some studying on it, okay? So that's the end of section 10. Now we go on to underwriting and insurable interest, the financial interest that a person must have in themselves or another person to purchase legally enforceable insurance coverage, must exist at the time of application or inception of the policy only. A policy obtained without insurable interest cannot be enforced. All right, 3 categories of insurable interest: blood, marriage, business. Okay, insurable interests are included in all 3 of those areas. Oh yes, I gotta go through this every day, folks. All right, application and field underwriting. Guess what? You're the agent. You're considered to be the field underwriter. All right, what you do is you collect answers to questions in section 1 and section 2 of the application, and you do the agent report. Section 1 is general information about the applicant, name, address, phone number. All right, the contact information. Section 2 is detailed health information. Let me tell you, folks, it's detailed. All right, and then third, there's an agency report. It's a section used by agents to list general observations and remains confidential. It is not included in the entire contract. Next, field underwriting duties. What you do is you complete the application, complete the premium, submit it to the home office, and then wait, because you can't bind any coverage. Only the home office can bind coverage. All right, you also have to provide the notice regarding replacement of life insurance, a life insurance buyer's guide so the consumer can bone up on all the things he doesn't know about insurance, or it gets tossed into a drawer somewhere. Next is the outline of coverage, which is basically the policy summary, or it could also be the illustration. Next, general procedures. The applicant and producer signatures, they signed the application. If it's a third-party contract, they need their signature also. And you have to complete the application. There can't be any blank responses, and it has to be in either blue or blank ink, because any other ink may have a problem in copying. All right, so you can put NA, or not applicable, on the application. If I was doing I was being asked the questions on a life insurance policy, they would say, are you currently pregnant? Well, I can put no, or I can put NA because it's not applicable. All right, well, what happens when you goof up, when you make a mistake? Everybody makes a mistake. Even I make a mistake. Don't tell my wife that. All right, but an agent cannot make changes to an application and must correct errors. You know, if the guy says to you, all right, well, I got cancer, you can't say, oh, they'll never issue this policy if he says that. I'm going to put down yes. All right, folks, it's an invitation to a lawsuit. All right, so you answer the questions as the applicant says them. All right, and if there's a mistake done by you, here's what you do. You take one line and draw it through the wrong response. Put the correct response. directly over the wrong response, and then have the client initial that change, so the company knows that the insured knows that that was a change done. All right, an agent who makes unauthorized changes to the questions asked on that life insurance policy is guilty of fraud. All right, so be prepared. Be prepared. If you're going to do that, you're going to pay fines, be suspended, and tossed in jail. Do things the right way, folks. They're always the best way to do it is always the right way. All right, next, a printed booklet describing all aspects of AIDS and HIV, including a list of counseling services, must be provided prior to any testing for AIDS. It's not unfair to decline coverage due to the discovery of the applicant having this disease. Test results can only be provided to the applicant or their physician with the applicant's permission. They cannot go to a third party, and with permission by the insured, they can go to the physician, Department of Health, or an approved HIV counseling center. But other than that, the results for the AIDS test is basically for two sets of eyes, the insurance company and the insured that took the test. State law prohibits discrimination with regard to testing for AIDS or HIV for people of the same class. All right, you cannot consider marital status or known or suspected sexual orientation. Nope, the insurer or the insurance company pays for the testing for this. All right, the written authorization, all right, the applicant has got to sign something which includes a statement of the purpose and use of the test, exam result notification procedures, limitations, and the right of exam confidentiality, and last but not least, the interpretation of the results. Now we'll go ahead and mosey on to underwriting. Okay? And home office underwriting goes ahead and gets the application that you've asked the question for the insured. If they've given you money, you go ahead and you forward both of those things to the insurance company, and the policy can either be accepted with adjustments, or denied. Okay? If it's just accepted, well then the insurance company will issue the policy as applied for. And so, basically, there's two things that have to happen to have insurance coverage. Number one, the applicant needs to fill out the application and submit premium. Once that goes into the office and the home office issues the policy as applied for, then the insured has coverage. All right. There may be an adjustment. All right. What if you're healthier than you think you are? Well, if that's the case, the insurance company will know it, and they will issue it at a lower rate or a preferred rate. But if you're not as healthy as you think you are, which is more the case than not, there are different adjustments the insurance can make, but still issue the policy. One of those is to change the class in which you're rated. Let's say, for example, you are a smoker, and your health is not so good. All right, and you go ahead and you submit the rate in as a standard smoker, but the insurance company looks at that and says, no, we're going to have to change the class to substandard. Well, what happens if you go ahead and you quit smoking? All right, and basically the effects of smoking last in your body for 5 years. Kid you not. After 5 years, if you wrote somebody that was issued at a smoker rate, you can have them retested, and they can qualify for either the standard rate or a preferred smoker rate. Okay, and that will save them money on premium. All right, and so you'd be helping out your client if you did that. Other ways they can go ahead and match the risk with the premium collected is have an exclusion. All right, we talked about exclusions. Or they could rate up the policy with a higher premium. Ways to do that, it's a step up in age rating. Well, I know, Mr. Jones, you're 35, but your health sheet is not so good, so we're going to rate you as a 36-year-old. All right. Next would be a tabular rating, and it's a tab from 1 to 10. All right. And so if you have a tab rating of 1, all right, then it's not going to be that much of a rate increase. You just missed the underwriting requirements. Or if you have a 10 in your tabular rating, you better get that policy, because if you're rated with a 10, there's something wrong. Man, you and your family need that policy no matter what the cost. All right? And so they do that. They do all those things, a percentage of rate. There's all sorts of ways they can adjust the premium payment to match up with the risk. If the risk is too much, they'll just not issue the policy. Nope, sorry, you're out of luck. All right, and so what do they use for sources of information at the home office? Well, of course, they use your application, the agent reports, and they'll actually call the insured to ask them questions. All right, they may want an attending physician statement or an APS. All right, and a medical exam, if that's required, that's paid by the insurer, or any lab tests, all right, to be performed. With me, when I bought my policy to protect my business, all right, they sent an attending physician statement to my doctor. And so I called them 1 week after they sent it out. I said, hey, have you got the APS back yet? Nope. Second week, nope. Third week, nope. Fourth week, I got on the phone to my doctor. Hey, doc, this is Jerry. Tyler, your patient. Listen, 1 month ago, my company sent out a check and a request for a attending physician statement, which it's been 4 weeks now, and you haven't done it. I just wanted to call you up and let you know that if it's not in there, into the insurance company pronto, if something should happen to me, I am going to sue you and have my family sue you for your failure of submitting the attending physician statement. Whoa, Chair, that's strong. Yeah, but it is what it is. And I had to do it. And when I did that, I didn't have to wait but 3 days. The report was sitting into the into the insurance company. All right. A little communication may be necessary. All right. They also look at consumer reports, the Medical Information Bureau, and that's basically any medical information provided by previous applications. All right, and it's shared among member companies. You can't get a copy of this as an individual. It'll show your health history, driving record, abnormal PAP studies. All right, because, all right, I'll give you the example why they do this. Somebody goes ahead and says, oh crap, I got cancer. I need to get a $500,000 life insurance. Well, make it $1 million. I need $1 million life insurance policy. And so they go ahead, they lie on their application, and the company finds out that yes, he does indeed have cancer. That information goes into the MIB, or Medical Information Bureau. And so when they deny his policy because he's got cancer, he says, well, heck with you guys. There's 100 other companies out there.
Hello.
Hey, Matt, how's it going?
Good.
You're doing really well with your progress.
Oh, thank you.
So, yeah, I was giving you a call to touch base and see if you scheduled your exam, because they do book up fast.
Yes, I did.
Awesome. What day did you schedule for?
I scheduled it for Wednesday,
Awesome. Uh,
the
okay.
10th.
Yeah. And how are you feeling so far about it?
There's a lot of information.
There is a lot of information, but
Yeah.
it's not a tough test.
Oh,
And
that's good.
yeah, and it's like it's one of those type of things. Um, it's not a one of those scenarios where you have to ace. Like if you pass, you did just as well as someone that aced it. And the other part of it is some of it you're going to learn so much more from our training than anything you're going to learn in that book. And so, like for example, there's one guy or one of our best agents. He's making almost $1 million a year. He failed 6 times before he passed.
Hmm.
And how do you explain that? So,
Wow.
uh, yeah, don't stress out about too much. That kind of stuff because I don't want you overthinking it where it could cost you a couple questions. But yeah, if there's a certain thing that you get hung up on, yeah, just talk to me.
Okay.
You know, did you get that email from Nicole about getting the court documents for your background check?
Yes, I did.
Awesome. And she didn't tell me she got them or not, so I just figured since I had you on the phone, I asked. But yeah, they always have to have it documented.
So they're looking. They want the actual ticket.
They want the court disposition.
Court disposition. Okay. Okay.
Yeah, so you're gonna contact that municipality if you don't have it anymore, or your lawyer or whoever might have it. You're gonna contact them and request the court disposition because we need in writing what you were charged for, what was if there's any plea deals, what you pleaded to. Everything needs to be documented. This is for them to approve it.
Okay. Okay. So I'll have to get a hold of them and. Okay.
Yeah.
Yeah. I don't know if we have it or not. I don't know that. It happened. In I was living in Barnegat when it happened, and we moved, and I don't know where it is.
Yeah.
Um,
It's okay. This happened to other agents. They just had to use both of them are digital now. You can just call them and request it. And they can send it to you.
hmm.
But sometimes you have to go down to Target or the place.
Okay. All right. Yeah, I saw there was something. I think there's some way of doing it. If I email them,
Uh,
I think there's some way of doing it that way. I'll have to do that then.
yeah, yeah. And the sooner the better too, because if you get past your life, you pass your health, and we still don't have that information, you can't start until we do. So because there's also other tasks that's a domino effect. So we complete that task, and then other tasks get released to you. So
Oh.
the sooner the better, because it just opens up all those other things that have to get done before you can be employed.
Oh. Okay. All right. I didn't know that. Okay.
Yeah. So like everything Nicole sent in you is like she's working on the paperwork to get your employee file started, and she's trying to work on it because it takes her like 2 to 3 weeks to get everything taken care of. So as you're studying for the life and health, she's trying to line it up so it's perfect timing. As you pass your health, she's also got the approval for you to start. And so like anything that she sends to you, it's almost like get it done as soon as possible because like she can't do the next thing until she gets responses to one thing.
Okay. So I gotta do health too. Okay.
Yeah, you need health. You can't, you need life and health to do employment.
Okay. Okay. All right. I didn't know that. Okay.
It's okay. They're separate tests anyways.
Okay.
Yeah, New Jersey doesn't let you take them together, so you're doing the right steps.
Okay.
And then all your receipts, hold on to your receipts and send them to Nicole because she does a reimbursement check for as you're completing it.
Okay.
Okay.
All right.
All right. Looking forward to it, man. Keep up the good work.
All right. All right. Have a good weekend.
Thank
And
you. You too. Appreciate it.
I'll keep working on it.
Yeah. Awesome.
All right.
All right. Talk to you soon.
Okay. Talk to you. Bye bye.
Bye.
So if you didn't care and you just got a copy of a policy and you said, here, all right, you've got a free look period, you need to accept it or reject it in that time frame, and you don't review it, guess whose fault it is if they go ahead and they accept it? It's your fault. You didn't even check it. You'd be dead in the water. So please, look at the name. Joseph A. Smith is not the same as Joseph B. Smith. It's a different person. Is the coverage amount correct? What about the effective date of the policy? Is that in order? What about the policy provisions? Are all the, what about the exclusions and riders and the endorsements? Are those on there? Is the payment plan correct? All right, who was the beneficiary? Is the beneficiary right? The premium, is that correct, or did they goof up on that? All right, and the ownership rights is included in the contract. You got to check these things, folks, before you deliver a policy. That's why you are the agent. And like I said, more times than I care to admit, I have found mistakes that the Home Office made, and I had to correct them before I delivered that policy. All right, so you have to look up your free look policy in the state in which you reside. And for senior policies, you're probably looking at 30 days. That's a repeat. All right, now we're going to talk about premiums paid with the policy. Now, premiums paid with the application, all right, an application's consideration comprises of two things, an application and a premium payment. Policy issue and coverage will not be provided until both elements of the consideration are complete, which means application and premium payment. All right, you can submit an application without the premium. It's referred to as a trial application or a request for the company to make an offer. We're going to go through 4 scenarios here shortly so I can show you that submitting in a trial application is, let's just say that you're not the brightest light in the bus. By doing things that way. All right, so the two things, you take the application, you send it to the company with premium. When they look at it, if the policy is approved as applied for, boom, there's coverage. All right, if approved, coverage will not be provided until the premium is paid. Well, that's on a trial application. If you got the premium in with the application, that's taken out of the scenario. And you'll see it when I will go through these 4 different scenarios here. The agent must complete a statement of continued good health and collect premium prior to delivery. In this case, the delivery date will be the effective date of coverage. It's the date where the agent gets the money in his hand. If the client's health has changed, it may be possible that that policy will not be issued. All right, so let's look at these scenarios. All right, So January 1, the app is taken, the premium is submitted to the company, takes 3 days for the home office to get it, they work on it, and on January 16th, they order a physical exam to be completed. The insured completes the physical exam, and on March 1st, all right, the home office denies the application due to medical impairment and returns the premium to the applicant. In this case, was the applicant ever covered? No. Why? Because he submitted in the application, but the policy has got to be approved as applied for. If those two things are submitted in, then you're good to go. What if the applicant accidentally died on January 20th? Is he covered? Why? Policy was never issued, folks. Next, all right, there is an insurable conditional receipt based on the insurability of the insured. And so on January 10th, the applicant provides the application information and premium to the home office. And there is a conditional receipt that is issued, and coverage is considered to be immediate if the policy is applied for, approved as applied for. All right, let's go through the routine again. January 13th, the home office gets it. The home office issues the contract on March 1st and sends it to the agent for delivery. The agent gets it on March 10th, and then the free look period begins upon delivery. Here's the question. In this scenario, when does the coverage become effective? What did the conditional receipt say? Receipt says the coverage is immediate if the policy is approved and applied for. So, when did the coverage become effective? January 10th, because both things are in effect. All right, they submitted the application and the premium, the home office approved it, and he's got coverage as far as January 10th. All right, what happens if the applicant dies accidentally on January 17th? Is he still covered? Well, that's before the home office issued the policy. Well, basically, the home office is not going to have any information within the 13 days, and they're basing their issuance of the policy on the prior health. And if the guy dies by accident on January 17th, the policy is effective on January 10th. Is he covered? Well, heck yes. He's covered. All right? So that's a good thing. Let's go to our next one. Here is where the conditional receipt says you need to have a medical exam. All right, so you got the app, you got the premium. There's the condition on the receipt says you have to take a physical exam. Same thing, 3 days later, the home office gets it. Then very next day, the applicant completes his physical exam. The home office gets it on March 11th and issues the contract, all right, as applied for, and sends it to the agent for delivery. The agent delivers the contract and the free look period begins on March 21st. When did the coverage become effective? What did the conditional receipt say? You have to take a physical exam. So if it's approved, then the applicant has coverage, all right, on January 14th, the date of the physical exam. Well, what happens if the applicant dies accidentally on January 17th? Is he covered? Well, yeah. The policy was issued. He sent in his premium. He sent in his application. And even though, all right, the policy was issued on the 14th, if he died on the 17th, they would pay. Oh, does it take that long? Oh, yeah. Yeah, it does. All right. And so that's one of the things, all right, that it's really not so good for the insured if he sends up a trial application. All right. So let's go ahead. Let's take a look at our next scenario here. We got a smart carp that says, no, I don't have to give you any premium. Just send my application. I want to know how much they're going to charge me. Okay, all right. So you send on January 10th. You send the application information without premium. All right, the home office gets it on the 13th and they start underwriting it. On January 16th, the applicant completes his physical exam. On March 1st, the home office issues the contract as applied for and sends it to the agent for delivery. Agent gets it. He has to fill out a complete statement of continued good health, collect the premium, and deliver the policy. All right, it's submitted without premium. So when do you think coverage became effective in this case? March the 12th. The date full consideration was paid. The premium had to be paid. Application has to be submitted, and the home office approves it. Well, they didn't get the money until March 12th. All right, and here's where it's a sad story. What happens if the applicant does this and accidentally dies on March 12th? Does he have any insurance coverage? The answer is no. There is no coverage. Why? Because he thought he was going to be a smart carp and just submit the application. Hey, he didn't know his number was up on March 9th. And so March 9th comes along, he dies, but there was no premium collected on the policy. So there is no coverage. Yeah, it could be if you go ahead, you select a monthly premium payment side. All right. It's just, hey, you just can't tell what some people can do. All right. How do you know how much to collect on the outset of the application process? Because you do a illustration showing his height, his weight. There are, you can ask him some health questions to see if he'll qualify for a preferred rate. And if that is, if that's the case, he'll give you the money for the preferred rate. I like to ask questions because I hate to go into deliver a policy to a guy and says, yeah, I know that we quoted $18 a month, but after it went through underwriting, it seems like there's some serious health issues. Your policy is going to be $35 a month. All right. There's people that are not going to like that. They're going to think bait and switch, and they're going to tell you to get out of their house. All right. When in essence, they actually need that coverage desperately because they're not as healthy as they think they are. All right. And so you do your best to go ahead to underwrite. All right. If you looked at me, you'll know that I'm overweight and I am not tall enough for my weight. They'll give you height and weight charts. You can ask them, how tall are you? How much do you weigh? And you can go ahead and put that against the height and weight charts, and that will tell you if they are within the underwriting limitations of any particular class. All right. And so I like to be as accurate as possible. I like to ask them as many questions as possible because I would rather come in and offer the policy to them and them get a decrease in premium than an increase in premium. All right. You know what I mean? All right. So, all right. Let's see. Well, if they were paying an annual, yeah, they probably have to pay that up front. They can do a monthly and then they can switch to a yearly if they wanted to, because you don't have to set your payment options at the beginning. I would go ahead and set it as a monthly, put in the monthly, and then if for any reason there's a problem, the insurance company is obligated to send you back every penny that you paid. Okay? And so, yeah, I'd probably go ahead and start out as a monthly at first, and then what you can do is you can do an endorsement to change it to annually if you want. All right, so do you see how this would hurt the insured? He doesn't know, all right, what was going to happen to him on January 10th, that was going to happen on March 9th. None of us do. That's why I got the insurance policy for my daughter. All right, next, we got a test. And the home office completes the underwriting and the risk is accepted. What would you call that? All right, well, you call that policy issuance because they accepted the risk, they issued the policy. Next, the purpose is determine whether to accept the risk. Well, whose job is that to find out if they're going to accept the risk? That's underwriting. Okay? Next, an important time frame begins upon the delivery of the policy, and that's the free look period. All right? And last but not least, the party who completes the attending physician statement. All right, now, this is another one of those questions. Gee, who do you think would complete the attending physician statement? All right, the doctor. Because he's got the education, he's got the authority, he knows what the situation is, and so that's who fills out the physician, attending physician statement. All right, that's the end of that section. All right. Or the PA, it depends on the company. I don't know if the company would take the physician's assistant statement on it, but I know they will take the doctor's statement on it. All right, and so that is a question you'd probably have to ask the company. But if you go ahead and put down who fills out the attending physician statement and you put the doctor, you're not going to get that wrong. Okay? All right, now I want you to pass this test so you can start your careers. All right, next, general insurance laws. And these are state-specific laws that apply to your state. Since we have people from all sorts of states in here today, the answers can be different. All right, so check these out. All right, or if you got your phone, take a picture of the screen or turn to whatever page it is on your download. All right, you have to know what the commissioner or superintendent of insurance, what are his powers and duties in your state. They differ from state to state. Next, insurance definitions. What is your state's definition of domestic, foreign, alien, mutual, stock, fraternal, certificate of authority? All right, next, licensing requirements. What are the licensing requirements? What do you have to satisfy in order to get a license from the state you're applying in? What are the continuing education requirements for producers? All right, or what if you sell long-term care or annuities? It's different in different states. For me, I've got to go ahead and I just finished my continuing education. I had to do 20 hours of continuing education in order for them to renew my licenses. However, there's some states that if the agents sell long-term care policies, a portion of their continuing education must include long-term care. Or if they sell annuities, the state may dictate that they need to have at least a 4-hour course for continuing education if they sell annuities. What is it on your state? I don't know. There's too many states to keep track of. All right, well, what about appointments and record maintenance? How long do you have to go ahead to keep a policy and receipt records in your state? What goes ahead and determines a suspension of your license? What is there? Is it a misdemeanor? Is it a felony? All right. What is it? Why can they suspend your license for what? Next, check up on marketing practices. What does your state go ahead to say regarding rebating? And that's basically giving money back to the insured for buying the policy. Misrepresentations or lying, twisting, and that's trying to twist the policy out of the current policy out of the hands of the insured by false information, defamation, coercion, unfair discrimination, fraud, commingling, false advertising, unfair claims practices. What is your state's policy on those things? Another thing, and this is pretty standard. All right, what about if you change your name and address? How long do you have to get it in? Well, that happened to me one time, and boy, let me tell you what, I just got it in like on the 29th day, right by the skin of my teeth, because that was not a priority. I had all sorts of fires to put out. And so I finally realized, because I wrote it down, all right, that I needed to do this change. So on the 29th day, I reported my change of address because I was in a new office. All right. And so you need to report those things in 30 days, because if they're trying to get a hold of you and they've got old information in their database, they are not going to be happy campers. They are going to be looking at fining or suspending. All right, so please, just if you have a change in name or address or employer, file that with the Department of Insurance in your state. All right, and reporting of actions. Well, there's some states, let's say, for example, if you get arrested for a misdemeanor, you've got to report that yourself to the insurance division. All right, or if you get arrested for a felony, you need to report that. Okay, if you don't report it, repercussions. Okay, so those are things that are state specific that you ought to take a look at, so you will be able to ace every question on that test. Okay, replacement sales and health insurance providers. Hey, look at that. We actually got into health 2 hours later than expected. All right, we are running behind. I have to admit that. All right, so let me take a sip of this. All right, pre-existing illness and injury. A new policy may not cover that. Healthinsurance.gov, policies sold on that site do not have any pre-existing illness. It's right from the get-go. But not all companies go through healthcare.gov. We'll talk more about them later. There may be a waiting period or elimination period. All right, a period at the beginning of each new disability where no benefit is paid. It's similar to a deductible for your car if you get into an accident, but on disability policies, they have a deductible in units of time and not in money. And so the longer you go ahead and have for an elimination period, the cheaper the policy is going to be. All right, and so I'll go ahead and I'll throw this at you. All right, just a little illustration. I'll make it quick. Your employer gives you a short-term disability policy. If you become disabled, the policy will pay you for 3 years, as long as you are still disabled. But 3 years, wait, there's some people disabled for the rest of their lives. Well, what can you do? Well, here's what you can do. You can go out and buy your own individual disability policy and pay for it yourself. But since the employer offers a 36-month policy for you, you can have a 36-month elimination period on the individual policy. And guess what? You're going to be surprised at the reduction of the premium on that policy. How many disability policies can you get? You know, hey, well, I guess as many as you're right, but all right, they will only go ahead and provide a certain percentage of your salary, because they don't want you to profit from having a disability policy. So you have a disability that your employer's plan pays for your salary for 3 months. After that, that's over. But now on your individual plan, that satisfies the individual plan. Now you collect payments for the rest of your life on the individual plan. It makes sense for some people. All right, a probationary period, a one-time event and policy issue, usually around 30 days, during which an illness is not covered, but accidents are covered. All right, now we're going to go into types of health insurance providers. We've got commercial companies that are private carriers. We have HMOs, which are health maintenance organizations. We have PPOs, which are preferred provider organizations. We have Blue Cross and Blue Shield organizations. We have employer-sponsored plans, and we also have government plans. Well, who do you think takes care of our veterans that are injured? The VA, the government. They have VA hospitals, they have VA doctors. The government takes care of our heroes. All right, payment. There's traditional fee-for-service, all right, to the insured who can assign benefits. All right, fee-for-service policies are slowly going the way of the dinosaur because they're so freaking expensive. Only rich people can go ahead and afford the traditional fee-for-service insurance policies because the premium is just outrageous. All right, a service provider can provide services directly to you based on your UCR. What is a UCR, you may ask? Well, it's your lucky day. I can tell you what UCR is. It's usual, customary, and, oh, gosh, I just went blank. Usual, customary, and reasonable. All right, that's what insurance is designed to pay, with usual, customary, and reasonable. Unfortunately, some healthcare providers charge unreasonable, all right, uncommon, all right, and so, all right, that's where we have a problem with those, and sometimes we'll have a fight between the insurance company and the provider. All right, but there's also managed care, and managed care goes ahead, and that's your HMOs and PPOs and Blue Crosses and Blue Shields. And what they do is they concentrate on keeping you as healthy as possible. And so by keeping you healthy, you're going to have less claims than if you were not so healthy. All right, so that's their goal. The only problem is you can lead a horse to water and not have them drink. All right, HMOs and PPOs have classes. They offer seminars. How to lower your blood pressure, how to lower your blood sugar level if you have diabetes. But then again, the customer has got to attend those, all right, and learn, and then put into action the things he's learned. That's the basis behind managed care. Blue Cross and Blue Shield. Well, Blue Cross is generally hospital benefits. Blue Cross deals with physicians. So it's one entity, Blue Cross and Blue Shield, hospitals and doctors. Members are referred to as subscribers. They're generally in a limited geographic area, as are the HMOs, and they may operate as a nonprofit service. Yes, they may, but let me tell you, they're making money. They're not doing it for free, folks. Basically, they have agreements and contracts with doctors and hospitals to provide services. All right, and those services and those operations are on a UCR basis. What is UCR again? Usual, customary, and reasonable. And some of those things may even be performed at a Blue Cross Blue Shield facility. You may not have to go out for x-rays. They got their own x-ray machine. All right, you may not have to go out for therapy. Maybe they have their own therapy unit. Okay, so let's go ahead and move on, and we'll take a little bit of a deeper dive here. All right, because according to the clock, we have got 57 minutes to go. Are we going to make it? I don't think so, but it's not going to run too far over, folks. All right, because some of these screens, they have a lot on them. Other ones have nothing on them. So let's go ahead, and I'm going to kick it in high gear. Health maintenance organizations offer preventive care. That's what makes it profitable for the HMOs. All right, the premium is prepaid either by the employer or the member. All right, their enrollees are members. Sometimes they have a small copay and of $10 to see the doctor. Other areas don't have a copay. I know in Florida, we are eat up with seniors. And for Medicare HMOs down here, you don't have to pay a premium. You don't have to pay deductibles. You don't have to pay a copayment for your drugs because there are so many seniors retiring down here in Florida. It's based on your geographic location, and then that will determine how much you have to pay. All right, so healthcare delivery with prepaid premium. Most are closed panel plans. Doctors on an HMO are usually employees, and the primary care physician is usually the gatekeeper. What happens with that? Well, the primary care physician puts a cold stethoscope, all right, I need a drink of this, on your chest, listens to your heart and says, oh man, that's not good. You're going to have to go ahead and have an appointment with the cardiologist. And so you can't see the cardiologist unless you get a referral from your primary care physician. So in that respect, he is called the gatekeeper because you can't go outside that office unless approved by the primary care physician. Why? It keeps costs down. All right? And so there may be some services at an HMO facility. Next, a PPO is similar to an HMO, but offers more coverage. All right, since the PPO enters into contractual agreements with hospitals and doctors, they don't charge as much. And I got a story to tell you with this. All right, they do not provide treatment directly. The PPOs don't, but they go ahead and they pay the hospital and the doctor to do the service for them. All right, and so they create preferred provider arrangements with the hospitals and doctors in exchange for a discounted cost. Contracts, folks. Employees and insurers may pay lower deductibles or a copay within the network, but one of the big differences is in an HMO, you have to stay within network. If you go outside and see a doctor or a hospital that is not in network, you got to pay the whole bill. They're not going to cover it because it's only doctors they're contracted with in network. All right, but on a PPO, employees or insurance can go out of the network, but they'll have to pay higher costs. All right, so it's a good way to keep all the doctors honest, is to have that second opinion. The HMO won't do it. They won't pay for it. The PPO will pay for it, but at a lesser amount, so there's more money out of your pocket. So there's no gatekeeper. You don't have to have a referral on a PPO program. My health insurance, yes, I'm on Medicare, but I'm on my wife's insurance policy because it's better. It's better than Medicare, folks. And so I'm on her policy. She's on a PPO policy. If I want to see my cardiologist, I just make an appointment. If I want to see my dermatologist, I just make an appointment. All right. And so there's no gatekeeper, all right, to try to go hold back costs. But since everything is contracted, that's the thing that lowers the cost. Next is Champus, sometimes referred to as TRICARE. What is that? That's a government organization that provides health care benefits for dependents of military personnel. Well, who provides coverage for military personnel? The VA, the Veterans Administration. All right, and so those are different types of health insurance providers. Our first activity, a replacement health policy will cover all ailments. Not necessarily. Remember, you have to read the question slowly. Will it cover all ailments? Well, maybe not. There may be pre-existing conditions. The coverage that you may have may not be with healthcare.gov, but with a private company that has their own pre-existing conditions clause. Next question. All right, TRICARE and Champus can be used as a replacement for any individual. Can that happen? Not on your life. TRICARE and Champus are dependents for military personnel only. They're not for the general public. Next, health insurance will pay for UCR medical bills. Remember what UCR is? Usual, customary, and reasonable. Well, will health insurance pay for that? Well, that's how they're designed. Yes, they'll pay for anything that's usual, customary, and reasonable. All right, but that's why you have health insurance. That's the end of section 13. Let's go ahead and go into our next section, which is health insurance policies. Three types of health insurance policies. We've got disability income that provides income if you're disabled, medical expense insurance, which pays hospital and doctor bills resulting from an injury or illness, or long-term care that pays for nursing home care. All right, when you go ahead and get older, it's also called custodial care. Let's talk about disability income first. Disability income is designed to offset the loss of income due to an accident or sickness. If you are injured or if you're sick, you can't work, you can't make any money. All right, so that's why you have disability income insurance. And remember what I told you with Social Security, who is the chief on reporting on disability, because they have Social Security disability income. 25% of people, 19 to 65, become disabled in their lifetime. Well, Jared, were you ever disabled? Yeah, I was disabled for 3 months. All right, it's a long story, but you know, I was. All right, so disability, all right, and the definitions vary by state and insurance company. A person's inability to perform any work or occupation. Hold on. A person's inability to perform any work or occupation for which the person was reasonably and qualified or trained. All right, there's two types of disability policies, folks. Any OC or own OC. They're hugely different. Any occupation means the inability to perform the duties of any employment or occupation, where own occupation has a definition of the inability to perform the material and substantial duties of the job that they were working at the time that they became disabled. Any occupation is cheaper in premium than own occupation. Why? Own occupation has more risk. All right, next, let's talk about a presumptive disability. What's the definition of a presumptive disability? It's a type of total and permanent disability based on the loss of sight, hearing, speech, or a loss of a limb. All right, basically, you don't have to go through claims. Man, if you have one of those, you are considered to be disabled, and you are paid your disability despite the fact that the insured can still be working at the job, and it's usually paid as a lump sum. Now, what about how do they figure it out? How do they figure out how much your payment should be? Well, there's a loss of earning test, and the disability's income is based on earned income, not unearned income. Well, what's earned income? Commissions, bonuses, salary and wages, all right, investment results, all right, those are all considered as earned income. Unearned income, rental income, interest, investment income. Why is that? Because, folks, even if you're disabled, you're still going to have money coming in from that, right? So it's only earned income that your disability income is based on, not earned income, unearned income, because that may work to somebody's advantage. Next, partial disability. All right, the inability to perform some, but not all of your daily duties. Follows a period of total disability. You can add partial disability as a rider, and it pays 50% of the total benefit, and it will pay up to 6 months. What about a residual disability? All right, well, it's another form of partial disability based on a percentage of lost income. Fluctuates monthly, and it must exceed 50%. Then we have here 5 and 6. We don't have any explanations, but what's the difference between permanent and temporary disability? Well, a permanent disability, folks, is one you're going to have for the rest of your life. All right, they can't go ahead and give you the training necessary to go ahead and recover from that disability. That would be more of a temporary disability. That's what I had. All right. Basically, what happened was I stepped off the curb at the agency I was working at, and I broke my wrist. I messed up my elbow, and I messed up my rotator cuff. All right. And I was driving a 6-speed car. I'm not going to tell you what car it is, but it had 6 speeds. And so this was my shifting hand, my right hand. It may be opposite in your screen, but my right arm was useless. So I had to work the clutch and shift with my left hand. My whole right arm was totally useless. But then I went to therapy. All right, and I got, after 3 months of being disabled, I was back into the swing of things. All right, so that's permanent versus temporary injury, accident versus a sickness or an injury. Well, folks, all right, if you're injured, all right, or in an accident and you're disabled because of that, that's different than having it from a sickness or an illness. You can still be disabled by an injury or accident, and you can still be disabled by having a sickness or an illness. All right, but basically they're pretty much self-explanatory. As we go to our next screen, what's a recurrent disability? And that is a disability. Let's say, for example, you become disabled and ended up fine, but within 5 months of the other accident, you go ahead and it comes back. All right, that would be considered a recurrent disability or a continuation of the original disability. Well, how do you know what the difference is? All right, the difference is 6 months. If it happens before 6 months, it's a recurrent disability. You don't have to satisfy any new elimination period. But if it is after 6 months, wah, wah, it's considered a new disability and you have to fulfill the complete elimination period before getting any payments. Next, we're finally getting to the elimination period. It's the period preceding each disability during which the benefits are not paid, similar to a deductible. But it's a time deductible, not a money deductible. Common elimination periods are 30, 60, 90, 180, and 365 days. All right? The most common of all of those is 90 days. All right, the longer the elimination period, the cheaper the policy. So folks, here's something, another thing that's not going to be on the test. It's just a factoid. This is a power question that you can ask your client, all right, when it comes to disability. The question is, George, how long, if you became disabled, how long could you keep paying your bills for? All right, did you have the resources saved? How long would that be? You're going to get answers anywhere from 30 to 365 days, considering the emergency fund of the insured. All right, if they say, oh man, I can only pay my bills for 30 days, they need a disability policy, folks. Remember, you know, you're looking at 65% of all Americans. It never used to be that high. All right, last year was 60. The year before that, it was like 50. It's exploding up with the use of credit. All right, and so the credit cards are more and more, and so people have less and less money to go ahead and live on. It's a mess. You should have a disability policy, all right, and go ahead and get the correct elimination period, because if you only have enough money to last for 30 days, you're going to be between a rock and a hard place at day 90 without any money coming in. Yes, it's going to cost more, but you know what? It's going to save your skin. All right, so we have two types of disability policies, occupational and non-occupational. Basically, an occupational DI policy pays in addition to workers' comp. On DI policies, workers' comp is a common exclusion. It will not pay for anything that's payable for workers' comp. And so to keep the policy premiums low, you're going to find that on a lot of disability policies. It will not cover workers' comp. That is called a non-occupational DI policy. It only covers for injuries or illnesses received off the job. Anything on the job will be covered by workers' compensation. Benefits are integrated with other benefits, and workers' compensation only pays for on-the-job coverage. All right, I had a story to tell you about that, but we're running behind in time. Individual policies, tax considerations for disability. And this is where it gets kind of a little bit wacky here, okay? And this only applies to disability policies, so keep that in your noggin. When it comes to disability policies, if you're paying the premium that you pay is not deductible from your income tax. However, the benefits that you receive from the policy are received tax-free. Why? You're the one that paid for the premium with after-tax dollars. Now, on group policies, There are non-contributory policies and contributory policies. Non-contributory, the employer pays the entire amount of premium for your disability policy.
Right.
You don't pay the first dollar. But if you ever get disabled, the benefits from that policy are taxable. Why? You didn't pay for it. They're considered as taxable. Next, contributory, where the employer pays all or part of the premium. The premium is deductible to the employer, but not to the employee. The benefit is taxable to the employee, but only the portion that's based on the employer contribution. So, if your employer is gleefully paying 50% of your disability policy and you become disabled, basically when you get your benefits in, only 50% of that is taxable because you coughed up the other 50% with after-tax dollars. All right, so if you're paying for it, tax-free. If somebody else is paying for it, you got to pay taxes on that, and that applies to disability. I'm going to go down this list quickly. Disability include income and exclusions, war and military service, and intentionally self-inflicted injuries, aviation other than commercial aircraft, a foreign country, loss of a professional license, and DI benefits may be paid on a limited basis from 1 to 2 years for mental or nervous disorders. All right, next, the guaranteed insurability rider. That's almost like the guaranteed insurability rider that we had for the life insurance. So you can get an increase without having to go through underwriting again. And we also talked about accidental death and dismemberment. Remember, death benefit, principal sum, dismemberment benefit is the capital sum. All right, now for disability, business disability insurance. And remember those 2 movies I told you to watch? I'll tell you, it'll be good for you. It'll give you more of a background. One is Knives Out for life insurance. For 2, Regarding Henry for disability insurance. I've had all sorts of people come back and tell me, oh man, I saw that. That was a good movie. You'll enjoy it, and if you're not careful, you'll learn something too. All right, there's something called business overhead expense. And what that does is it pays for the usual and customary business expenses if a business owner becomes disabled. All right, well, here's the difference. It doesn't pay the owner disability, but it pays for his rent, mortgage, utilities, phone, employee salaries. If there is a business overhead expense policy taken out for disability, and premiums are tax deductible, but the benefits are taxable. All right, that is a business overhead. Okay? All right, you said what names? Michael, please verify. I don't know what you mean by that. So send me a chat. Oh, the movies. Okay, thank you, sir. The names of the movies. 1, Knives Out. Knivesout. Stars Don Johnson and Jamie Lee Curtis and Frank Oz. The next one is Regarding Henry, and that stars Harrison Ford. You know, you will enjoy these, and it will give you an insight into what companies need to have for insurance. All right, so that's business overhead insurance. We talked about key employee and buy-sell later, earlier on. And so, key employee, if something happens,
shut the door on, Jack. That was
the business
nice.
to train and hire a
I
replacement
never do that to
person. All right, premiums are not deductible, however, the
Yeah.
benefits are tax
Barking
free.
up a storm.
Next, the buy-sell. All right, what if somebody's disabled, a
kids?
disabled partner, and that is
Any
where
word?
regarding Henry comes in. All right, they could have saved a lot of money
Okay.
by just getting
Well.
a disability policy, but no, nobody ever mentioned it to them. And hey, you know what? You make
I got
commissions
two of
off that.
these.
So use disability benefits to buy out the
Five,
interest of the
$6.99
disabled
at
partner.
Burlington Coat Factory.
Maybe lump sum or periodic, similar to buy-sell for life insurance. All right, next screen, workers' compensation. It's supposed to be a mandatory coverage, but like everything, you know, hey, there's speed limit laws, but how many people do you actually see that stay within the speed limit? You know what I'm saying? All right, so coverage provided for injuries and illnesses occurring on the job. All right, and see, the one thing about having workers' comp is if you have workers' comp and your employee is injured on the job, you've got coverage for him and they cannot sue you. Very important benefit for workers' comp. All right, and this litigious society we live in now, everybody and his little brother wants to go ahead to get money the easy way. All right, it offers unlimited medical benefits. All right, survivor income, replacement and funeral expenses, disability benefits, and also rehabilitation. All right, no problem, Spencer. All right, so let's go ahead and keep on going because we still got a ton of stuff to go through before we end here in about 30 minutes. All right, let's talk about a basic health insurance plan. And let me tell you what, basic describes it. All right, it's first $1 coverage, it's no deductible, and it comes in 3 sections: daily room and board, miscellaneous and ancillary expenses, and you can have a different rider on it for surgical expense and physician expense if you cough up the extra bucks. All right, so let's go into the basic plan. What do they pay for daily room and board? This is an example. They pay a specified dollar amount for a specified number of days. The example, we'll pay $250 a day for 100 days. In all reality, folks, just paying for the room in the hospital costs $500 and more. Of course, the basic plan will pay $250 of that, so they're not going to kick you out of the hospital. But now your hiney is in the ringer for the balance of that, and that's just for the room and board. It doesn't mean tests, doctor services, etc., etc. That the test and everything comes under miscellaneous ancillary expenses, and so they cut you a break and give you 100 times the daily benefit, the daily room and board benefit, or $25,000. Folks, have you ever been in a hospital? Have you ever been looked at what they charge? I'll tell you what, if you haven't, I'll tell you my experience. I went in the hospital in 2021. I was there for 4 weeks. You know what my bill was? $350,000. I requested an itemized billing from the hospital, which they gave me. And on that, they told me, because I am paying the contracted rate, all right, if I didn't have insurance, that $350,000 would turn into $600,000 for my hospital stay. Is that outrageous or what? That's why we are in trouble with health insurance today, because we put a Band-Aid over the problem. All right, so it's expensive, room and board and miscellaneous experience, not to mention what the doctors charge and what the surgeons charge. All right, Oh, Olivia, I'm sorry to hear that, kiddo. Oh, man, I bet you got tired of the food real quick. All right. Hey, Derek, there you go again. All right. By the time he got out of the hospital, his bill was in the millions. Folks, you gotta have insurance. A basic plan is something, and the only thing that it's better than a sharp stick in the eye. All right, it's something, but it doesn't come close to paying the bills. Now let's talk about major medical, and we'll see if we can breeze through this. Major medical has high coverage limits, $1 million and more. All right, what happens when you exceed the limit? Tag, you're it. All right, so there's $2 million policies out there that you can get, or unlimited policies. Folks, $1 million does not go far in a hospital these days. And that's why a lot of people find themselves in bankruptcy court because they can't pay for the medical expenses.
That's crazy.
All right, they have a deductible, which, as we already know, is sharing the risk. You pay that first before the insurance even kicks in. After you pay the deductible, then there's co-insurance, in which the insurance company will pay 80% of the charges and you pay 20% of the charges. And there is blanket coverage in case your blanket gets sick. No, that's forget about that. All right, blanket coverage goes ahead and covers a myriad of different ailments, but there is a stop loss. Thank God for the stop loss, because you can be in the $1 million just paying that 20%. So there's a stop loss, and we have an illustration of that coming up. All right, and so there are also limitations inside the policy. Basically, on a major medical policy, they won't cover for plastic surgery. All right, they won't take care of that. They won't also take care of wellness. All right, appointments. You've got to have something wrong with you. All right, and so let me take a look at this chat here real quick. All right. Oh, man. All right. God bless you, Dee. All right. Oh, man, it's just incredible. All right. Yeah, man. You just made my day. That's great. All right. Nothing more important to the parent than the health of their child. All right. And so, exclusions on a major medical policy: war, cosmetic surgery, routine dental, claims covered by workers' comp, any expenses covered by Medicare or Medicaid, intentional self-inflicted injuries, care in a government facility, long-term care is not covered, and private nursing is not covered. All right, basically, we went through this before, but this will show you the stop loss. You've got your deductible you pay. After that, you pay 20% until you get to a stop loss. So here's an example. All right, person's got an $80,500 claim. They have a $500 deductible, so they pay that $500. All right, now they only have to pay $80,000, and so the company goes 80-20 with a $5,000 stop loss. Well, guess what? 20% of 80,000 is more than 5,000. But since they have the stop loss, they will end up paying their deductible. They will be paying their entire $5,000 of the 20%. And then after that, the insurance company would come up and pay the remainder of the bill. And what would the insured pay without the stop loss? There's the $500 deductible and the $16,000, which is 20%, $16,500. Folks, The middle class can't take hits like that. That would just put them under financially. Okay? And so that's why I'm such a big believer in insurance. All right, if I didn't have insurance, I'd be living in a house that said Westinghouse on the side of it. All right, I'm a big believer in an insurance. All right, next, coverage for dependent children. All right, covered at the moment of birth, regardless of birth defects, can remain on the family and accident plan until the age of 19 or 23, or full-time college students, not including medical plans. Folks, there are so many different age things in here. We've got 19, we've got 23, we got 26, we got 30. Folks, we're just going to skip over this. Check out what your state says about how children are going to be covered up to what ages, please. Okay, it's too confusing. All right, so taxation of medical plans. Well, unlike the disability plan, remember, that's kind of like an oddball. Well, if the employer pays for your group premiums, they're deductible for the employer on his income tax, and the benefits from it are received tax-free by the employee because the IRS does not consider that as income. All right. Well, what about the disability policy? Yes, it's income. You're replacing your income. But on major medical, the benefits are not considered income. All right, because it's not. All right, individual premiums are not deductible if you have an individual policy. Reimbursement benefits are not taxable since they're not considered as income. And for individual plans, if premiums and other non-reimbursed medical expenses exceed 7.5% of the gross income, the excess is deductible. Folks, I have a sneaking suspicion that that amount went up to 10%. All right, you want to find out for sure? Go ahead and find out on the IRS's site and find out on medical expenses what the number is. I have a feeling it's 10, not 7.5. Next, dental insurance. And I got a story to tell you about this one too, but I don't think we're going to have time. All right, so dental insurance, limited or specialized policy that's designated to provide diagnostic and preventive treatment and care. All right, I'm going to read that again because you're going to see that again. Limited specialized policy that's designed to provide diagnostic and preventative treatment and care. There is often no deductible for routine preventative care. Co-insurance and coverage limitations or exclusions can apply. It's very expensive due to the high frequency of claims for dental, and it may be offered as a part of medical plan or standalone plan. And folks, that might not be a bad idea to get an appointment with a dental insurance carrier. All right, and that is somebody that has the real insurance and not a discount plan. Because that's a part of the story I was going to tell you. Oh, heck with that. I'll tell you real quick. I had a discount plan. I went to my dentist and I had a problem. He gave me a free examination and free x-rays because that was included in my discount plan. And he came back and he said, I'll be back in 10 minutes with a treatment plan. He came back in 10 minutes and said, all right, Jer, you have got to have this done. And he had a whole bunch of different Latin terms I didn't know to save my life. And so I said, all right. He says, when would you like to begin treatment? And so he closed me. That's a close if you're in sales, okay? And I said, well, Doc, it depends. How much is this going to cost me with my insurance? And he said, well, the total bill for all your treatment is $6,000. When would you like your treatment to begin? He closed me again. All right. And so I answered him with this beautiful objection. I told him, Well, I'll begin my treatment as soon as I can sell my car. Needless to say, I never went back to that dentist again. He was in it for the bucks. All right, so categories of treatment. Let's restorative. That's basically fillings and crowns, oral surgery, endodontics, root canals, and treatment of pulp. Periodontics, that's gums. Prosthodontics, that would be dentures, and orthodontics, corrective devices to move the correct spacing in your mouth of your teeth, such as braces. I actually was in a networking group with a dentist, and he said the best customers for me are people with teeth and people without teeth. I thought that was really kind of cute. All right, so let's mush on from there. Dental group plans, all right, concerned with adverse selection and may impose limitations or reduction of benefits. For a probationary period, there is no conversion plan for group dental. However, the insured may continue to utilize benefits via COBRA. When it comes to COBRA, I stick my finger down my throat because it's so expensive. We'll talk about that a little bit later. All right, we've got 17 more minutes to go here until we hit the right time of 6 o'clock. And we have got, we got a whole bunch of screens here to go ahead to go through. 46 screens it looks like. But I'll hang in there until the very end. If you're willing to hang in there, you don't have to. It's a review. There's no credit. There's no grade issued. So if you need to bop out, you can bop out without any fears of repercussions, and you can download every screen that we're going to take a look today on that PDF file. You'll be fine, folks. All right, so group insurance. Well, this is something that we talked about that goes ahead and is basically the same thing as the life insurance contract. We talked about the contributory, non-contributory taxes. All right, we're making up time here. Actual claim experience of the actual group is your actual experience rating for group insurance. And there's also a community rating for smaller groups or brand new companies that are coming in. They'll go ahead and use community rating for the first year. But then after that, they'll take a look at their experience rating and go ahead and rate the group by their claims experience. All right, to become eligible for group insurance, employee must be in a covered classification to satisfy any probationary periods, be full-time employee, and full-time is not based on hours worked, not age, income, length of employment. All right, it's based on hours worked. All right, and that's usually 30 hours. If you work 30 or more hours, that's usually considered to be full-time. Under 30 is part-time. Coverage begins on the date of the employment, and coverage, there could be a coverage or a probationary period. Dependent coverage must be offered to both spouse and children. If the spouse and children don't elect coverage, then they have to wait to the next open enrollment period, which is a year away. And folks, frankly, I wouldn't do that. I would try to get a policy through healthcare.gov form. All right, next, Consolidated Omnibus Budget Reconciliation Act, affectionately known as COBRA. All right, it's a federal law which is applicable when employees leave the employment of a company that has over 20 employees. All right, an employee and qualified beneficiaries continue their group benefits under COBRA. The employee is responsible for paying the premium, and the premium for COBRA is 102% of the group premium. Well, Chair, 102%, that doesn't sound bad. What do you mean it's so expensive? Well, basically, it's expensive, folks, because you got to take care of the whole nut. You've got to pay what your employer was paying, all right, to give you the coverage. All right, let's say you are paying 25% of your health insurance. Well, now you've got to pay 3 times as much. Plus an additional 2% kicker to cover administration costs. It's expensive. All right, I would just go to healthcare.gov and get a policy. All right, qualifying events, you can get an extension. All right, an 18-month extension due to termination or layoff, a 36-month extension due to death, divorce, or a child leaving home, a 36-month extension due to the employee becoming eligible for Medicare, and the employee beneficiary has 60 days to notify the employer of their desire to go ahead and utilize COBRA, because then the employer has got to notify COBRA. All right. And so next, let's talk about Medicare and group insurance. Coordination of benefits, Medicare versus group. All right, well, you're working for an employer. And this is important because, man, I have a lot of people ask me questions on this. So we're going to take just a little bit more time on it because of its importance. Chair, can you tell me, I'm getting to be 65, I'm going to qualify for Medicare. All right, do I just take my Part A only, or do I pay for my Part B coverage? All right, and here's the answer. It depends on how many people are in your group. If your group is 20 plus employees, let's say you've got 21 employees in your company and you're in there, well then in that case, Medicare is secondary, your group insurance plan is primary. All right, and so myself, I have rejected Part B coverage, and I've rejected that for a number of years. When my wife decides to retire and she's going to lose her health insurance, then that's when I'm going to activate my Part B back. All right, because like I told you, her insurance is a lot better than what Medicare offers. It's a great plan. She's working for a great company. All right, so Medicare is primary when there's less than 20 employees. So you got 18 employees in your company, get the Part B coverage. Because if you don't get the Part B coverage when you're supposed to, good old Uncle Sam will make you pay a penalty. The longer you delay, the greater the penalty, and that penalty will only last until the rest of your life. You're stuck paying that. All right, so here is the line in the sand, folks. How many employees is in the group? 20 plus employees. Then Medicare is secondary. Your group plan is primary. Less than 20, you better get the Medicare because it's primary. You're going to have buku money coming out of your pocket if you don't have that Medicare is your primary. Okay? Word to the wise here, folks, and you guys are going to get that question too an awful lot. All right, next, an individual is treated for end-stage renal disease. The group plan will be primary for the first 30 months, and then after 30 months, Medicare will then become the primary. At one point in time, many moons ago, if you had end-stage renal disease, you could not qualify for a Medicare Advantage policy. That has changed a couple of years ago. If you have end-stage renal disease, yes, you will qualify for a Medicare Part C plan, or what they call Medicare Advantage. All right, now we're going to talk about HIPAA. All right, and the purposes of HIPAA is to help ensure individuals don't lose their medical coverage. It limits pre-existing condition limitations when changing jobs. Remember many hours ago when I told you that if you're working for a job and you leave that job, get a certificate of coverage, because you're going to need it to prove insurability when you get the job with your next company. Okay? And that applies to groups of 2 or more people. It assists individuals who change jobs by limiting pre-existing condition exclusions. That's good. Increasing medical benefit portability, expanding COBRA eligibility benefits, and providing favorable tax treatment. Next, it provides portability. If an employee was covered by a previous health plan with no gap in coverage of 63 days or more, then the employee can use this time covered under the previous plan to offset pre-existing condition exclusions on the new plan. But remember what I said, you have to request the certificate of coverage from your old employer. That's the way to prove it, because nothing gets done in insurance if it's not on a piece of paper, folks. All right, next. If the employee has been without insurance for 63 or more days, the full pre-existing condition exclusion applies. All right. So if you go to one job to another, you've had 63 days of coverage or more, you're in like Flint. But more than 63 days, all right, then you're at their mercy. Pre-existing condition exclusion can only be excluded under new plan if treatment or advice was provided within 6 months of enrollment into the new group. The condition can be excluded for only 12 months. All right, so after 12 months, they will treat your pre-existing conditions. All right, however, if an individual is a late enrollee, there is an 18-month exclusion that applies. All right, next is the Patient Protection and Affordable Care Act, which I call the Not So Affordable Care Act, because it's not so affordable. It was a good idea when they first came out with it, but like I said, they put a Band-Aid on the cause of the problem. So let's go through this really quick, because I do want to talk to you about healthcare.gov for a little bit. All right, state-based insurance exchanges, which subsidies are available for uninsured and the self-employed. All right, that's healthcare.gov. Subsidies are available for low-income individuals who want to buy their own insurance. Yep, it depends on how much you make. You can have your premium subsidized. It results in a decrease in Medicare spending, an expansion of Medicare eligibility requirements. It allows dependent children to remain on their parents' health plan until the age of 26. All right, it includes kids that no longer live with their parents and not listed as dependents on their parents' tax return. No longer a student, or they're married. Well, how could they do that? Okay, well, anyway, be that as it may, let's mush on. We're running out of time. An insurer is not able to deny coverage due to pre-existing conditions, so you can't deny, you can just postpone. Employers with 50-plus employees are required to provide health insurance to employees or be fined $2,000 per worker annually. Yes, folks, in the healthcare.gov, they got rid of the individual fines, but they still have the fines for employers. And I went, just for yucks, I went to the state of Florida in here, I put my zip code in and found out what the cheapest plan available to provide health insurance would be. And so the cheapest plan available was $3,200 a month, and it didn't give you diddly squat with coverage. All right, no, $3,200 a year. Back that up a little bit. All right, so here's an employer. Do I get the coverage for my employees that's $3,500 or more a year? Or do I just say you're on your own and I pay the $2,000 per worker because it's cheaper? You wouldn't believe how many employers are out there will pay $2,000 per worker instead of offering health care coverage to their employees. If I was ever involved in a company like that and found out that that was the thing, I would go ahead and I'd say, see ya, don't want to be ya. All right, so I quit. All right, because hey, look at this aspect. If he cares more about money than you do, all right, then how's he going to treat you during your days on the job? You're trying to go ahead and perform your job. He doesn't, it's just, he's going to try to squeeze every drop of blood out of you, and he's going to pay the fine instead of giving you medical coverage. He doesn't care about you, or she doesn't care about you. All right, let's get on with this. This establishes new requirements to prevent Medicare fraud and abuse and eliminates lifetime maximums for health insurance benefits. Whoa, well, that's a good thing. All right, so there's 10 essential benefits. 10 essential benefits. There may be a test question that will ask you, what are the 12 essential benefits? Are there 12 essential benefits? No, there are only 10, and let's go through them. Ambulatory patient services, emergency services, hospitalization coverage, maternity and newborn care, mental health and substance abuse services, prescription drugs, rehabilitative services, devices, lab services, preventive services, wellness services, and chronic disease management. And last but not least is pediatric services. Healthcare.gov applies to that. Our next screen, all right, now we'll talk about the different mental levels in healthcare.gov. And let me tell you what, you need to familiarize yourself with these because there have so many variants in them. All right, the bronze plan, basically 60% of all the money paid is paid by the insured and 40% is paid by the individual. Well, unless you don't have a lot of health care needs, all right, you're going to go ahead and pay $3,200 a year. You're not going to meet the deductible of $9,000, so you're paying $3,200 a year for nothing. Okay, so cheap is not necessarily the way to go when it goes ahead and it comes to different mental level plans. Bonnie, it was good having you in the course. All right, good luck on your test. All right, and have a good evening. Because like I said, if you have to jump off early, it's okay. I'm going to finish the course, all right, regardless of what the time is. All right, so metal tiers, bronze plan, silver plan, gold plan, platinum plan. One of the things you should ask your client is, well, how much do you use the health insurance? Well, if they don't use it a whole lot, maybe that you don't need to put them in the bronze plan where they pay $320 a month. All right, maybe they'd be better off with an indemnity plan that will pay them something if they go to the hospital, because the bronze plans have $9,000 deductibles to them. The company won't pay anything out until you go over $9,000. And if somebody's in good health, they're not going to hit that. All right. So silver plan, more is paid by the insured. Myself, with my needs, I think I'd probably be better with the gold plan, where the company pays 80%, 20% by the individual. That would be reasonable. All right, and the platinum plan, all right, and so the platinum plan pays 90%, and the individual pays 10%, but the premium is up there, all right? But on the other hand, all right, they don't have the huge, massive deductibles, all right, that's associated with the other plans. So please do this. You don't have to do it, but it just gives you a better background. Go to healthcare.gov, and they make you chase around the website for a long time, but see if you can find a comparison of all plans according to your zip code. See what they cover. See how much they are. Because somebody just going to the website, I want the cheapest I can get. Well, they can get the cheapest, but they're going to pay out the nose because they chose the cheapest plan. It's human nature. All right, but anyway, those are the different medical plans. Let's mush on. All right, open enrollment. There's an open enrollment period from November to January each year. It allows new enrollments or changes and existing coverages to be made. Basically, in the real world, I don't worry about it because the television commercials on the old boob tube is basically, it explodes with ads for health insurance. All right, so you always know what open enrollment is. Special enrollment. Let's say if you have one of these things that happen, if you lose your job, if you have a child being born, a marriage or divorce, then you can qualify for a special enrollment period, but you need to do it within 60 days of the event. All right, if not, then you're going to have to go ahead and wait to the next enrollment period. Health savings accounts. Let's talk about these really quick. And what do we have here? 30. Oh, we still got a bunch of screens. All right, well, I'll tell you what, I think we're going to finish by 7. All right, but hang in there. I'll see if I can go ahead and get through these as fast as I can. All right, health savings account, a personal savings account that are designed, all right, to offset reimbursed medical expenses, must be used with high deductible or high premium health plans. Benefits are portable, available to almost any people, and employers can contribute funds. All right, now we have MSAs and HSAs. All right, well, what's the difference? Well, contributions are tax deductible to both employer and employee. They both grow tax deferred in your account. If you don't use them, they carry over from year to year. So it's not, if you don't use it, you lose it. Earnings and qualified withdrawals are tax-free, but there is a catch-up provision of $1,000 from age 55 to 65 that you can stick in your account. Now, there are similarities and differences between medical savings account and health savings accounts. They're both qualified tax-free. They're both non-qualified prior to age 65. And they are both taxable as income. All right? And if you're not going to use that for a medical reason, let's say you want to buy a new Xbox, you have to pay an additional 15% tax penalty with the medical savings account, but with the health savings account, you've got an additional 20% tax penalty because you didn't use that money to go ahead to pay for qualified medical expenses. Okay, wrong pipe.
There's a lot of material that covers.
Yeah. All right, non-qualified after age 65, you take them out, non-qualified, it's still taxable as income. We have another test, and I think there's 13 activities here, folks, so you'll have an idea. Carolina, All right, no problem. You have a great day, and enjoyed having you in the class, kiddo. Good luck on your test. Good. Oh, I'll tell you what. Oh, this will probably stop right after I get done teaching the class. Okay. The disability insurance feature that makes the beneficiary wait for payments. What is that? That's called the elimination period. All right. What about business overhead expense? What does that cover? Well, one of the things it covers is it covers employee payroll. It doesn't cover the business owner. He needs to get his own policy. All right. Requires the patient, all right, to pay for some of the medical bill. All right. Well, that's major medical. Why? Because you've got the deductible and you've got the 20% until you hit the stop loss, right? And it's designed to pay for preventive care and diagnostic tools. It's what I read twice because I told you you'd see this again. That's dental insurance and a law that requires ease of portability when switching health insurance. That is HIPAA. All right, the end of section 14. Now we're going to go into senior policies. Medicaid. What Medicaid is aid for the needy or indigent. Federally funded program. All right, the feds donate 10%. It's state administered, and the lion's share of the funding comes from the state. 90% funded by the state. The federal government only kicks in 10%. All right, it provides aid to family with dependent children or temporary aid for needy families. It offers public assistance and welfare, and it's based on need, not age. Medicare based on age, 65. Cha-ching. All right, but this is not based on age, it's based on need. And there are some people that will spend down their assets to qualify for Medicaid. But they have a 5-year look back. All right, and I can tell you this long story, but I'm going to cut it real short. If that is your financial plan to have Medicaid take care of your long-term care, please, I beg you, visit a Medicaid long-term care facility before you make that decision. I don't want you to walk into a nightmare. Okay? Yeah. Been there, listen. All right? Please do that. All right, so hospital doctor, lab, x-rays, early diagnostic for children under 21, family planning, nursing home care for the financially indigent, and benefits provided by a federal health center clinic, and certified midwives and nurse practitioners. All right, old age survivors disability health insurance. Well, the benefit provided, well, you've got Medicare. All right, and that will go ahead and cover your hospital and doctor coverages, all right, for those over the age of 65. But here again, you got to pay for your Part B. Retirement benefits for those who are age 65 or older, all right. Well, you can take it at age 62, but you're going to end up with 40% less of your regular payment. And if you're still working, you have to give 50% of everything you make to the government. That's why I did not retire at 62. I retired at my full retirement age. All right, next, there's the lump sum death benefit, $255. They offer disability benefits, survivor benefits. We've been through this. All right, dependent benefits are paid until the child reaches the age of 18 or 19 if still in high school. Federal fund is financed by payroll taxes. And here again, they say 7.65. I think it's changed. All right, and the self-employed pays 15.3. All right, when we were on our other break, I had just enough time to go to the bathroom and look up the answers to these questions. So folks, I pass them on to you. You can go ahead, you can look them up. You're the folks that are taking the test. All right. Disability, definition under Social Security. It is harder than all get out to get disability from Social Security. All right. So, because their definition is unable to engage in any gainful employment, whether that employment exists in a person's immediate area. All right. So I live in Broward County. Hey, if I can do a job in Orlando, I'm not disabled. Go to Orlando, get the job. We're not giving you benefits. All right, your disability has got to be expected to last 12 months or result in death. There's a 5-month waiting period for the benefits begin in the 6th month, and those benefits are not paid retroactively. The benefit is based on your primary insurance amount, and that is basically, remember we talked about that, that's the amount that you put into the system in the first place. All right, let's see if we can fly through this. All right, if you're fully insured, have 40 quarters or work 10 years and put into the system, then you're fully insured, you get retirement and survivor benefits. All right, what about if you're fully and you're disabled? All right, and you've worked 20 out of the last 40 quarters. All right, well then you qualify retirement, survivors, and disability coverage. But if you've only worked 6 out of the last 13 quarters, you qualify for the survivors and the death benefit only. And here we go to the primary. I told you we're going to see this many times. The primary insurance amount. That is a formula done by Social Security to deliver your amount that you're going to get in retirement. And you want to know that? What is your primary insurance amount? Go to SSA.gov and look it up. You register for the website. You don't have to be 65 to do that. And you can find out how much money you can expect to receive when you're retired. All right? You need to start planning now, folks, because you've got the advantage of the time value of money on your hands. All right? If I wanted to retire as a millionaire, I'd probably only have to save $500,000. No, I take it back, $50,000 a month. Can't do it. I'm too late. Okay? But you have time, and time is magic when it comes to growing money. All right, so your benefit is based on your contribution. There is a blackout there's a blackout period, which pertains to survivor benefits, and following children's survivor benefit before Social Security benefits are payable. All right, so children receive the benefit to the age of 18, and then they're probably going to have to qualify on their own dime. All right, Medicare, we talked about this. Age 65 or older, or you can qualify for Medicare if you've been disabled for 24 months or longer, or you can have end-stage chronic renal disease. What does that mean? That means that you don't have to be 65 to get Medicare. And guess what? I bet you there's going to be a question on your test that asks you, do you have to be 65 or older to get Medicare? The answer is no. Disability for 24 months or have end-stage renal disease. All right? Next, Medicare Part A and Part B. We know that Part A is hospital. We know that Part B is medical, but you have to enroll in Part B. All right, to go ahead and get covered. And in my case, they sent me, when I turned 65, they sent me a letter. And on my letter, it had Parts A and B on my Medicare card. And I'll notice there that if I wanted to reject the Part B coverage, all right, that I would send that into Social Security. And so basically my Part B was covered by a qualifying insurer because my wife's company had more than 20 people working for it. All right. And so I rejected my Part B. I rejected my Part B this year. All right. When my wife retires, I'll have to get to take it out. But because I have qualifying coverage, I will not have to pay a penalty. All right. So, general enrollment period sometime between January 1st, March 31st. Coverage begins July 1st. The initial enrollment period is a 7-month period, beginning the first day, 3 months prior to age 65, and 4 months after. So 3 and 4, 3 above 65, 4 months after. That's just for the enrollment period. All right, so we have a chart here with everything that's covered under hospital insurance by just Medicare alone. All right, and so this is kind of, this chart is kind of misleading in one area that, and I'll tell you how. All right, so you've got, you're in the hospital from day 1 to 60. 60 days is a benefit period. All right, Medicare pays 100%, but after the deductible, so they don't pay 100%, do they? Dee, God bless you, lady. You have a good evening and good luck on your test. All right? What's that? Okay, so they pay 100%, but you got to pay the deductible. What's the deductible? Well, they just changed it again for 2024. It's over $2,000. All right, well, for day 61 through 90, all right, Medicare pays 100% after the daily deductible. Well, what's the daily deductible? Over $700 a day. All right, and when you hit the 90, they'll pay 100% after the daily deductible. What's the daily deductible? $900 a day.
Wow, man.
How much money do you have in your bank account, folks, that you can go ahead and stay somewhere for $900 a day? And after your 60 lifetime reserve days, what does Medicare pay? Nothing. You pay 100%. So that's what Medicare will go ahead and offer. Skilled nursing facility, you can look at the chart, days 120, 100% after the deductible. You got to pay the deductible. And then days 21 to 100, you've got to go ahead, they'll pay 100% after the deductible, but you got to pay the deductible. But here is a bright light in the midst of darkness. Beyond 100 days for skilled nursing care, all right, Medicare pays nothing. You got to pay 100%. Of course, you can tell I'm being facetious. All right, home health care. All right, basically, Medicare doesn't really provide home health care unless it's in conjunction with a hospital stay. You have to be in a hospital for 3 days, admitted, not for observation, and the doctor must approve it or order it. All right, and so what does Medicare pay? Medicare pays 100% for the approved amount and 80% for durable medical equipment. You've got to pay the other 20%,
Wow, man.
which is not a bad deal, but on the whole, Medicare does not cover home health care. It's only with a hospital stay. So long-term care, Medicare is not going to pay the first dime of that, folks. All right, that's why people need either the endorsement for their life insurance policy or they need a long-term care policy. Because let me tell you what, it's expensive. And most people don't have enough money in their bank account to go ahead and pay for the first year. But it is what it is. All right, hospice care. That's when there is nothing medically can be provided for you, you're going to end up passing away. Well, for hospice care, Medicare will pay 100% of that. But when you're in hospice, it's you only got a week or two. All right. Blood, they will pay 100% after the first 3 pints. Well, you got to pay the first 3 pints. What's the going rate of blood right now? $500 a pint.
Wow.
All right, just so you know.
Damn.
It's not going to be on the test. All right, but the pints, how many pints are covered? All right, that's going to be on the test. All right, they don't cover the first 3 pints. You do. All right, so hospital insurance, there's a benefit period, 60 days. Medicare approved benefits. All right, it has to be Medicare approved benefits that are paid by Medicare. If you're covered by private insurance and Medicare, all right, then Medicare is the secondary payer, which means they'll pick up the slack. All right, if there's any slack to pick up in their coverage. All right, but if you're with private insurance, you have more than 20 people in, then your company plan is primary. All right, if you have less than 20 people, Medicare is now primary. You better get that Part B coverage, or you're going to be spending a lot of money. All right, well, Jerry, I'm not worried about it because I'm going to sign up for Medicare Part C. And, okay, all right, I'll go ahead and I'll tell you the good, bad, and the ugly when it comes to Medicare, Medicare and a supplement, and Medicare Part C coverages. All right, same enrollment periods, and they won't cover things like physicals, routine foot care, eye care, hearing exams, eyeglasses, hearing aids, dental, and cosmetic surgery. In addition, Medicare will not pay for physicians or surgeon fees, outpatient drugs, private rooms or private nursing, the first 3 pints of blood, we know that already. Personal items, no, sorry, supplies, appliances outside the hospital, custodial services, nope, nursing home, unless with a hospital stay, 3 days hospital stay and approved by a doctor. Chiropractic care is not covered. Cosmetic surgery is not covered. Care outside the U.S. is not covered. All right? The only way to get that is to go ahead and be covered by a Medicare supplement policy. Some of the plans will offer coverage outside the U.S. All right. Allison. Beautiful. I'm so glad. I'm happy for that kiddo because I want to do more than just teach a class. I want to help prepare you for your new career choice. And I know you are going to go ahead and do well. Good luck on your test and blessings right back to you.
Wow.
I'm blessed every day. Okay.
Man.
All right. So, acupuncture is not covered. Eyeglasses and dental is not covered. All right. Now we go into Part B, medical services. And basically, doctor services, supplies, yada, yada, yada. All right. Inpatient and outpatient delivery. Medicare will pay 80% of that. You pay 20% plus the deductible because they won't pay the deductible. What's the deductible for Part B? Somewhere around a little bit over $200. I don't know what the amounts are for 2024. All right. Clinical labs. Okay, Medicare pays for 100%.
Wow.
Holy moly. All right, home health care, we talked about that before. Outpatient hospital care, unlimited if necessary. All right, and Medicare will pay 100%. All right, with few exceptions. Well, basically, they actually don't do 100%, they'll pay. You paid the deductible plus 20% of the approved bill. Wah, wah. So that's why I said the chart's a little bit misleading. Blood, unlimited if necessary, but they won't do the first 3 pints. After the first 3 pints, then you pay the Part B deductible and they will pay them. And this bottom here is something we covered on the last screen. And now we'll talk about Medicare Advantage plans. All right, Michael, have a great day. Enjoyed having you in the class. We wish you good luck on your exam, sir, and that you'd make plenty of money in your new career. All right, take care of you and your family, and have a good evening. Bye now. All right, so Medicare Part C, those are Medicare Advantage plans. And let me see if I can explain this to you. All right, Medicare Modernization Act happened in 2003. The program